performance measurement and evaluation. Chapter number 9 is transfer pricing, and we have devoted a lot of time on these two chapters. We have covered number of case studies and understood the concept through case studies. Application of the concept in the given situation we have covered in detail. As a part of performance measurement tool or performance measurement system, we have one more chapter in the series, that is chapter number 8. I will share the screen of our module, ICAI module on chapter number 10. Just give me a minute. You have over here chapter number 10, which is strategic analysis of operating income. Basically, it is profitability analysis. At the top management level, management is always concerned with what are the factors which are responsible for increase in profit, or why the profit has deteriorated over the years. What are the factors responsible for decline in profit or maybe increase in profit? And detailed analysis of the causes is done at the top level so that necessary corrective action can be taken by the top management. It is a part of performance measurement system. Top management can hold certain persons responsible for decline in profit. Certain divisions, if they are not contributing to the profit of the organization, then management can have a different view about continuance of those divisions or lines of business. So necessary corrective action can be taken in case a particular business unit is not performing, and that too consistently on Y-to-Y, year-to-year basis. So management always carries out this analysis called profitability analysis. One way of doing this profitability analysis with the help of cost data is lay down the standards, lay down the targets, and compare the actual versus standards or the budget. And that is what is called variance analysis. All of you have studied in intermediate CA as well as in final CA, standard costing and variance analysis. This is one of the performance measurement tool which is used by the management for evaluating the performance of a division. Whether a particular division is incurring cost within the limit or not, whether it is achieving the sales target, whether it is achieving the profit target or not, all that will be compared with standards which are laid down and variances are calculated. Then the management will probe into the variances. Some of the variances are controllable, some are uncontrollable. So obviously management will investigate into the controllable variance and find out how we can correct those adverse variances. Now a variant of variance analysis, I am putting like this, a small variation of variance analysis is in terms of profitability analysis using some other techniques. So in today's class, only one session has been devoted for this topic, chapter number 10, strategic analysis of operating income. Right? The chapter title is in front of you. I'll scroll it down. The learning outcome, better to tell in the beginning itself, only two learning outcomes. Number one, evaluate the profitability. Evaluate the profitability over the years. Generally, the data is compared for 2 years. So 2018 versus 2019, evaluate the profitability. What are the factors responsible for increase in profit or decrease in profit in terms of different reasons or causes? And evaluate activity-based management. It's a new technique that is used. Activity-based management is practiced in many companies nowadays in India and of course abroad, whereby you can track the cost of every product, not directly, but via activity, right? And can decide whether a particular activity is needed or not needed in the value chain of that business. In the value chain of that business. If the activity is not adding any value, then that activity is done away with, that is discontinued. If any activity is adding value, then it is continued and more focused attention is given for that activity. So if any activity is adding to the cost, no problem, so long as that activity also adds value along with the cost. If it doesn't add value, it only adds cost, then probably the second thought, reintrospect into that activity. That is what is activity-based management, where cost data is collected or compiled based on activity and the cost drivers. We will understand more in detail about this activity-based management slightly later. But first we will concentrate on how to evaluate profitability. So in today's class, we are going to learn different facets of profitability analysis. different facets of profitability analysis from the point of view of strategy building. And that is why name of the chapter, Strategic Analysis of Operating Income. At the business profitability level, how do you ensure that there is maximum profit years after years and there is no decline? Causes which are responsible for decline in the profit are addressed by the top management immediately, and next year again the performance improves, or next quarter the performance improves. So this performance evaluation can take place on a quarterly basis, on 6 monthly, on an ongoing basis. Generally it is done for the year. That means 2 years profitability statement always is compared in terms of revenue, in terms of cost and the profit. And finally, the management can do some analysis and reconciliation of profit between the 2 years. So invariably, in all these techniques of profit analysis, what we are going to learn today, we will understand what are the reasons for increase or decrease in profit and how to prepare profit reconciliation statement. Like bank reconciliation statement, even profit reconciliation statement must tally automatically. That means last year's profit and current year's profit, the reasons for difference in the profit, the reasons for difference in the profit must be highlighted, must be quantified in monetary terms or giving financial value. You have to assign the financial value to those causes. So we explain these causes with the help of a reconciliation statement called profit reconciliation statement, right? So we will start with our different techniques of profitability analysis. The chapter is divided, the overview is given to you. You have in this chapter strategic profitability analysis. I will slightly increase the font. Strategic profitability analysis, wherein we are going to understand, yes, profit increase or decrease because of growth. The first reason, growth here is nothing but increase in the market size. And increase in the market size happens because there is an overall increase in the market for the industry as a whole, and therefore our company's business also expands. Now this is something which is not controllable by the management of a company, because industry expands. So I belong to that industry. My company, my business belongs to that sector, and therefore my business also shows the increasing trend in terms of volume. So when we talk about the growth, that means profit increase on account of growth. This is growth in the quantity of units which are sold. So number of units sold or volume of output, volume of sales increase because of overall increase in the market size. That is what is growth. Every parameter can be further analyzed in terms of cost and revenue, also cost and profit. So you have growth parameter also expressed in terms of cost and in terms of profit. We have second reason, and that is cost leadership, right? Michael Porter, very famous management author, management guru, what we say, Michael Porter, who designed so many theories of management, mentioned very clearly in his one of the theories that a company can show sustainable profit years after years. A company will be in a position to show sustainable profit years after years if it can demonstrate cost leadership, product differentiation, innovation, etc., etc. Michael Porter mentioned that companies should demonstrate cost leadership. Cost leadership means having competitive advantage over the competitors in terms of cost. If competitor is producing the goods at a certain cost, the cost of production of our company should be slightly lower than, marginally lower than the competitor's cost structure. That is what is cost leadership. So whether in terms of variable cost, in terms of fixed cost, our entire cost structure of the product should be well designed, should be well within the control of the management. So cost leadership vis-a-vis competitor and vis-a-vis competitor's cost. So that is required. Innovative strategy, that is product differentiation, bringing out new product designing or new product features and giving more value addition to the customer. So bringing product differentiation. So you have strategic profitability analysis in terms of product differentiation also. So three types of profitability analysis we have seen. One is growth, other one is cost leadership, and third one is product differentiation. According to Michael Porter, yes, a company will show sustainable growth in profit consistent profit in years after years, growth in profit years after years. If it is in a position to maintain cost leadership, it is able to reach that product differentiation stage at every juncture in the design of the product, or once the product is launched, somewhere in between, continuously giving some value addition or added feature to the customer. That is product differentiation. Maybe a different specification of the product, different pack size, different variant of the product, something different so that it catches the attention of the customer. Now, all this is in terms of management theory, but ultimately as finance professionals, you and me, chartered accountants, ultimately will have to do this analysis in terms of quantitative evaluation, and quantitative evaluation will require financial analysis. Quantitative evaluation will require assigning financial values, monetary values to the factors responsible for increase or decrease in profit. So that is what we are going to learn under three banners: growth, cost leadership, and product differentiation. Right? We can also talk about productivity. Productivity is change in the profit due to increase or decrease in the output. So only because of volume effect, we have volume effect and we have price effect. In variance analysis, I'm sure all of you would have learned when we used to do the profit reconciliation, we always used to say a particular variance occurs because of two factors. One is volume effect and other one is price effect. Now, volume effect by calculating quantity variance or volume variance, and price effect by calculating price variance. Now, these techniques which we are going to learn in today's class, techniques for evaluation of profitability, all these techniques also make use of same concept of standard costing but with a slight variation. So I can say that these techniques of profitability analysis which we are going to learn today, they are variants of, slight variations of, variants of variance analysis. That is standard costing and variance analysis. We also understand profitability analysis through activity-based costing. So see on the right hand side, we have direct product profitability, DPP. We will prepare a statement called direct product profitability statement, and customer profitability analysis. See the change or paradigm shift in the approach of the management. Look at a paradigm shift in the approach of the management. At one point of time, management used to talk about overall profitability either at the operating level, that is at the top, that is at the business level, or at the bottom line, that is net profit level. Right? We used to compare the profit either at operating level or at net profit level. That's all. For the entire product, that means without going through the individual component of the product cost, without going through the individual element of product cost. Now here, if we want to find out direct product profitability, it is possible with the help of this new technique, DPP, direct product profitability, where the retail costs are also the costs which are directly related to distribution, supply chain management, logistics, transportation. These costs are also assigned to the product, right? So we don't consider only direct material, direct labor, direct expenses, etc. But we also consider the retail costs, which also are significant till the time the product reaches the final consumer. So right from transportation of goods from warehouse to the retail, from retail to the consumer, the transportation cost, warehousing cost, logistics cost, supply chain management cost, all these costs are also divided, apportioned to different products. These are common costs. They are divided to different products on the basis of some suitable base. And all of you have also studied at intermediate level in costing different bases of apportionment of cost. Like for example, storage cost is divided on the basis of floor space. Storage cost is divided on the basis of floor space, or maybe volume of output handle of each product. Right? What each product is occupying in the godown in terms of square meter or square feet, based on the area occupied, based on the storage space, we assign the storage cost, distribute the storage cost among the products. So some suitable base is followed, is applied for apportionment of these retail costs, supply chain management costs among the products while doing direct product profitability. So this direct product profitability makes use of activity-based costing for analysis of profit. Right? So we track TRACK, we track or we find out trail of each product cost breaking into individual elements and do an in-depth or detailed investigation analysis of the product cost and the product profitability. That is what is direct product profitability. And we have second technique, customer profitability analysis. This also we are going to learn. Customer profitability analysis talks about whether each customer is profitable to the business or not. Which customer is more profitable than the other? For example, there are certain customers who bring more business for the company. Certain customers, not only in terms of volume, but in terms of also the margin. Now those customers buy our products, which are costly products, and also and they are consistently buying, loyal customers. So when we compare the customer profitability, obviously the customer who brings more profitability to business, that customer, we don't mind giving him some loyalty bonus, some discount. So discount structure is always linked with the loyalty aspect of the customer. So how do you measure the loyalty aspect? Not in terms of only number of orders placed or number of times in a year he is purchasing from us, but also on the value of business, what he is giving in a year, and the margin what company draws from that customer. So how to do the customer profitability analysis? Again, through linkage of different activities, cost of those activities, we are going to understand in this chapter. And the third important part is ABC, ABM and ABB. Again, another three words. ABC is activity-based costing, activity-based management, and activity-based budgeting. Right? In order to facilitate activity-based costing, you must have a proper framework in the organization, what we call activity-based management. This is a philosophy, or this is a mindset at the top management, that let us follow activity-based management, where every activity is being tracked in terms of its cost and linking that activity to the final product. Right? And activity-based budgeting, on those lines the budgets are prepared, standards are prepared, so that actuals can be compared against the standards. So it's a decision-making tool. Activity-based costing, it is highlighted here, is a decision-making tool. I have shown you the highlight of this chapter. So we divide this chapter into three parts. First is strategic profitability analysis, this left-hand side portion. Strategic profitability analysis. So we will understand with the help of formulae, with the help of calculations, how the profitability analysis is done, how profit reconciliation statement is prepared for 2 years. Secondly, the second part of this chapter is profitability analysis through activity-based costing. So we'll understand two techniques, direct product profitability, DPP. Again, some numerical problems we will solve on this, and customer profitability analysis, that is CPA. Right, very famous or popular in the management or in the corporate circle by the abbreviations DPP and CPA. DPP is direct product profitability, CPA is customer profitability analysis. Right, and of course ABC, that is the third part, activity-based costing and activity-based management. Having understood this overview, we will start with product profitability the strategic profitability analysis using and here of course value added activities, non-value added activities, which I mentioned about. So we start with profitability analysis using various techniques, and these techniques are in terms of growth, product differentiation, productivity, and of course innovation. So we will understand one by one how we calculate or measure the impact of each factor on the profitability. How do we measure the impact of each factor? Each factor could be growth factor, that is market size, or it could be market share, or it could be it could be product differentiation, cost leadership. So how do we measure impact of each of these strategies, each of these factors on profitability of the company, and that too for 2 years by preparing a profit reconciliation statement? I will highlight this line, Michael Porter's sentence. Michael Porter, in its generic strategy theory, has suggested that a firm can survive profitability in the long term if it chooses its generic strategy according to the environment in which it operates and which conforms to overall corporate objective. Mr. Michael Porter has talked about two things. A company can achieve profitability in the long term, sustainable profit in the long term, if it chooses or opts for a generic strategy according to the environment in which it operates. An organization must have a flexible model. Remember this, organization must have flexible model. No management can afford to be static or rigid in its operation. According to the market circumstances, according to the conditions, market environment conditions, it should be able to adapt and modify its business model. So a company which adapts itself to the changing environment and which conforms to its corporate objectives, mission, is in a position to survive profitably in the long run. And for that he suggested number 1, cost leadership, which we discussed about. That is, it produces its product at a lower cost than its competitor, and it enjoys maximum market share. Or if it produces the products with some peculiar features which makes it different from others. You can see this product differentiation. So either cost leadership or product differentiation. So produce the product at a lower cost than the competitor and enjoy the maximum market share. Obviously, if your product is priced at a low level, obviously you will have maximum market share. Or you can produce the product with some peculiar features, value-adding features to the customer, that is product differentiation. Whichever approach a firm may adopt, finally it will have to compare the actual performance with the standards. Standards have to be laid down and then find out the deviation, the actual variation of actual from the standard, so that necessary corrective action can be taken. So what is profitability analysis is mainly to achieve this objective of correcting the loopholes or correcting the weaknesses in our operations, so that consistently organization can perform well and can achieve its target profit on a sustainable basis. With this basic understanding of profitability analysis, let us concentrate on 3 factors. From our numerical angle, we are concerned with these 3 factors. That is growth component, point number 1. Point number 2, price recovery component, that is price effect. So first is volume effect, growth component is volume effect, price recovery is price effect, and third one is productivity. Productivity is again in terms of its efficiency in operations and in terms of volume. We can measure growth in terms of volume as well as value, cost as well as output. Price recovery again we can measure in terms of volume as well as in terms of price. But productivity can be measured only in terms of volume. So we'll understand the impact of all 3 components on profitability of the company for 2 years. So remember these keywords: growth component, price recovery component, and productivity component. First we concentrate on, it is given in the chart also, so that chart is very easy to understand. Strategic analysis of operating profit or operating income, divided into 3 broad components. One is growth component, second one is price recovery component, and third one is productivity component. Right? These words must be fit in your mind. You must register these keywords, because whenever you prepare a profit reconciliation statement, it should be on the basis of these 3 components only. For each of these components, you can prepare a working note, work out the individual figures, and then put those individual figures in the reconciliation. But profit reconciliation statement should have a standardized format, and that is last year's profit, previous year's profit at the top, current year's profit at the bottom, and we are explaining the reasons why there has been increase or decrease in the profit, right? With the help of these 3 components, which is growth component, then price recovery component, and productivity component. When we talk about growth component, it has 2 dimensions. One is revenue effect, other one is cost effect. When we talk about price recovery component, again revenue effect and cost effect. But productivity component, I told you, only cost effect. There is no question of any revenue. So growth in terms of revenue, growth in terms of cost. Price recovery in terms of revenue, and price recovery in terms of cost. When we talk about cost, obviously we have VC and FC, variable cost and fixed cost. All of you are aware that variable cost per unit remains the same, but fixed cost remains the same on totality basis. Remember this thumb rule at the back of your mind. Fixed cost remains fixed on a totality basis. Variable cost remains constant on a per unit basis. So as volume changes, obviously variable cost also will change, right, on totality basis. And fixed cost also will change because per unit incidence of fixed cost will undergo change. So because of the peculiar nature of VC and FC, right, there is a cost effect on account of increase in volume. So increase in volume can be tracked or traced to two factors further. One is revenue effect, other one is cost effect. Similarly, price recovery component can be traced or tracked into two components, revenue effect and cost effect. And then productivity component only in terms of cost, because here we talk about volume alone. Let us look at growth component first. Growth component, it measures the change in the quantity of output sold. I have highlighted, so you can also jot down when you are studying for the exam, you should make your own notes and highlight the key learnings from every chapter. So growth component, when you talk about, it measures change in the quantity of output sold. That means operating income increases or decreases because of change in revenue and change in cost, because of change in output. That is how the growth component we elaborate. Now, how do we calculate in financial terms? First, we understand revenue effect. You will realize that these formulae are only manner of understanding, way of understanding. I don't want any one of you to by heart these formulae. They are not required to be remembered or memorized, right? They are similar to our formulae on standard costing and variance analysis. In variance analysis, we used to say price variance, standard price minus actual price into actual quantity sold. Like that, we used to remember at intermediate level various formulae for variance analysis. This topic, profitability analysis using different techniques, I told you, is a slight variation. It is a variant of variance analysis. It's a slight variation of variance analysis. So here we don't calculate variances in terms of favorable, adverse, etc. But here we find out the actual effect of growth, effect of revenue, effect of price, and of course the effect of productivity. Right? Effect of growth, effect of price, and effect of productivity. So let us first understand growth effect. Growth component is divided in two parts, revenue effect and cost effect. Revenue effect, let us look at the expression, actual units of output sold in the current year. Actual units of output sold in the current year minus actual units of output sold in the last year. Into bracket, there is difference in quantity. Revenue effect of growth we are calculating. Growth component divided in two parts, revenue effect and cost effect. So revenue effect, we look at the actual units sold this year minus actual units sold last year. Difference in volume multiplied by selling price. Why selling price? Because we are looking at revenue effect. It is not cost effect. So growth in terms of growth component in terms of revenue effect. So multiplied by selling price of last year. That will give you, because we assume that there is an increase in the volume of output. So current year output is more than last year's output. So find out the difference in volume, multiply by selling price of last year, you get revenue effect of growth component. I think this formula is very simple to understand. So we can proceed with this. By the way, as I said, these are generic formulae, general formulae, so you need not by heart. You can yourself work out based on the language of the question, based on the data given in the case study. You can always work out the growth component, effect of growth component, effect, that is revenue effect, cost effect, and so on. Let us look at the cost effect. Cost effect of growth for variable cost. Variable cost, obviously this is a growth effect. So your growth component, and therefore inside the bracket you will continue to have difference in volume. But now here the volume will be in terms of inputs. So how many inputs, how many units of inputs are required for producing the current year output, right? Current year output in last year. Always, if you remember, this is the terminology, produce current year output in last year. That means the number of units in variance analysis, if you remember, in the material volume variance, we used to always calculate like this, saying that how many units of raw material required for actual production, standard quantity required for actual production minus actual quantity consumed. Right? See whether you recollect these formulae for calculation of material volume variance, material usage variance, what we used to call. Material usage variance used to be calculated this standard quantity of raw material required for actual output. standard quantity of raw material required for actual output minus actual quantity consumed, actual quantity of raw material consumed. So inside the bracket, you used to talk about input quantity. So here also, now since we are talking about growth component bifurcated into cost effect. Revenue effect is over. Cost effect of growth component, we will take into account units of input required to produce current year's output in the last year, right? Versus actual units of inputs used to produce last year's output. What is the actual consumption of raw material, actual units or actual volume or actual units of input consumed vis-a-vis the standard inputs that should have been used for manufacturing actual quantity. Standard inputs required for actual production minus actual inputs. Inside the bracket there is input, so outside the bracket it has to be input price of last year. Right? Like to like operation, simple arithmetic like variance analysis, like to like operations. Inside the bracket input in number of units, so outside the bracket it has to be price of that input, cost of that input per unit last year. This is how you will design your own formulae. Wordings can change here and there, but finally you should apply the formulae correctly for the given case or in the given situation. So this is cost effect of growth for variable cost. Let us now look at the fixed cost. Any questions in conceptual understanding, you can ask me in the link. Yes, cost effect of growth for fixed cost. For fixed cost, again we look at the capacity. All of you understand fixed cost gets divided, spreaded across volume, total volume. That means depending on the capacity utilized last year and current year, we have the fixed costs which get apportioned, fixed costs which get divided. Right? So actual units of capacity in the last year, if adequate to produce current year's production in the last year. Current year's production in last year means standard quantity for actual output, something like that. Right, so standard capacity and here actual capacity that is used. So we find out the volume of units of finished product, because fixed cost we consider on finished product, multiplied by price per unit of the capacity in the last year. Inside the bracket it is units, so outside the bracket it is price per unit of the capacity. So this is cost effect of growth for fixed cost. We measure fixed cost in terms of capacity utilization. Budgeted capacity and actual capacity of last year and what capacity should have been there based on current year's production equivalent to last year, something like this, right? So I hope all of you have understood this growth effect. Growth effect is divided into two parts. One is revenue effect, growth component divided into two parts, revenue effect and cost effect. Right? So, and cost effect again divided into two parts. One is variable cost and fixed cost. And based on that, we will be able to work out how much is a contribution of growth component into the profitability of the company for 2 years. And while doing so, we are aware that market size has increased because of factors beyond our control. There is a difference between the word market size and market share. You will have to understand this properly in context of this topic. Market size means, of course, it is volume effect. That is growth effect. Market size means growth effect. Overall, the industry has grown by 2% or by 3%. There is a great demand in the market for similar kind of products. There is a great demand in the market for similar kind of products. So industry as a whole has grown by 2%. So why my company will lag behind? I am also into the same line of business, line of activity. So even my organization also has grown by 2%. So if I have actually grown by 5%, then out of 5% I can attribute 2% to size of the market. Market size has increased and therefore I have grown. It is not because of my efforts. Overall market size has grown. So if overall increase in volume or overall growth is 5%, then out of 5% I can attribute 2% to this market size, and that is what is growth effect. Balance 3% could be on account of either a market share, or it could be cost leadership or product differentiation, or productivity, any permutation combination, right? So let me wait and watch. So 2% certainly is on account of industry increase, industry growing at 2%. That means the market size growing by 2%, right? This is the way of understanding. Right? Conceptually, in strategic cost management, you should be absolutely clear. Then applying this knowledge in the given case study, in the given numerical problem will be very easy task for you. Please do not mug up or by heart any formulae. We come to price recovery component. After discussing this growth component, we will understand price recovery component. Price recovery component results in change in operating income mainly because of change in price and giving rise to again change in revenue and change in cost. Right? Of course, change in price because change in cost. It is cause and effect relationship. So in price recovery component also, we have revenue effect, we have cost effect. And we have seen that in the table. So when we talk about price recovery component, revenue effect is measured like this. It is price recovery. So in the numerator, like a price variance in the numerator, in the bracket, not in the numerator, in the bracket, we will have selling price in the current year and selling price in the last year, the difference between the two. So selling price in the current year minus selling price in the last year, that is in bracket. Multiplied by inside the bracket, it is price. So outside the bracket, it is actual units of output sold in the current year. Actual units of output sold in the current year. And be clear, in growth effect, we were taking the base as last year. In the growth component, we were taking the base as last year's volume. But now we are taking current year's volume. So slight modification in your thought process, in your mindset, slight modification in your thought process, in your mindset is required. When you look at the growth component, that time you take outside the bracket last year's output. Right, last year's units, volume of output. But here, for looking at price recovery component, you take actual units of output sold in the current year. Right, obviously because you are taking into the bracket difference in the price. And difference in the price of current year versus last year multiplied by actual units sold in the current year. So that will give you revenue effect of price recovery. Now we look at cost effect. Cost effect again could be because of BC and FC. So both are given in one table, one box. So these boxes are very important. Though we don't use verbatim as it is this formula, we understand based on your conceptual clarity, we apply this and we don't by heart or bug up any of these formulae. So cost effect of price recovery for variable cost. Again, inside the bracket, it will be input price. Why input price? Because it is cost effect, and that too on account of variable cost. So input price in current year minus input price in last year. Inside the bracket, it is input price. So outside the bracket, it will be number of units of inputs required. Always we do like to like. Always in arithmetic or mathematics, we do like to like operation. Inside the bracket, if it is difference in price, difference in input price, then outside the bracket, it will be actual number of inputs, actual number of units of inputs required to produce current year's production. Current year's production equivalent to last year. Always it is standard output it is something like this, standard quantity required for actual output. Standard quantity required for actual output. So units of input required to produce current year's output equivalent to last year. That is that is outside the bracket. This will give you cost effect of price recovery for variable cost. Now for fixed cost, again there is a cost effect of price recovery. Again we go by capacity utilization. So inside the bracket, now we have price per unit of capacity in the current year minus price per unit of capacity in the last year. Now it is price, not input price, but it is price per unit of capacity in the last year. Inside the bracket price, so outside the bracket it is actual units of capacity in last year. So you multiply it by units of capacity in last year. If you try to look into the formulae, language of the formulae and try to mug up the formulae, you may get confused. You may get total confusion in your mind. So it is always better to understand conceptually and in light of a given numerical problem. So in short, you remember price discovery component again divided into two parts, revenue effect and cost effect. So there is a change in profit because of A, growth component, B, price recovery component. And price recovery component is mainly because of change in the price of the commodity, change in the price of the finished product. And last one we look at is productivity component. Productivity component will measure change in the operating income due to changes in the product mix or yield. You remember you had calculated mix variance or yield variance. In material variances, we had calculated mix variance or yield variance. So change in the product mix or change in the product yield, mix variance or yield variance of inputs as compared with last year. That is called productivity, input-output ratio. That whether the business is operating at its full efficiency or not. Efficiency in manufacturing operations. What is the meaning of productivity? Productivity means efficiency in manufacturing operations. Is there any wastage of input? If input is 100 kg, output could be 97 kg. That 3 kg is the process loss. Process loss could be normal loss, it could be abnormal loss. If it is normal loss, it cannot be controlled. But abnormal loss can be always controlled. So management always measures this input-output ratio or product mix or product yield, and that is nothing but measuring the productivity. So productivity component will measure the change in operating income on account of change in the product mix or change in the yield. Basically, it is the volume effect. And therefore, there is only productivity in terms of cost effect. There is nothing like revenue effect. So please remember, for productivity word, there is no revenue effect. It is only cost effect. So cost effect means into bracket we have again standard cost of input. Into bracket we have actual units of input used to produce current year's output. How many units of output are required for actual production minus actual units of input which are required to produce current year's output vis-a-vis last year. So we measure what is the standard quantity of raw material required for actual minus actual quantity of raw material consumed, right, will give you that variance or that variation. So inside the bracket it is units of input. Outside the bracket it has to be input price. All of you understand finance CA students, so logical in your approach. You have to be absolutely logical and like to like. So inside the bracket it is units of input. Outside the bracket it has to be input price in the current year. That is productivity component. So can we say that productivity component as well as the price discovery component will take outside the bracket current year's production or current year's price, current year's input cost as the case may be. Whereas growth component will take outside the bracket last year's data. Right? Obviously, because we are measuring the growth to the base with respect to WRT, with respect to the base year of last year, the base data of last year. Right? So can we summarize this discussion before we solve the problems? We have there is one more, this is the cost effect of productivity for variable cost and cost effect for fixed cost also we have. Cost effect for fixed cost is again in terms of capacity. So now you are aware by this time actual units of capacity in the current year minus actual units of capacity in the last year equivalent to current year's production. Or current year's production equivalent to last year. That means in terms of what we say, in terms of last year's production. Inside the bracket, number of units of capacity. So outside the bracket, price per unit of the capacity in the current year. So we have productivity effect, productivity component divided again into one part only, and that is cost effect, but cost effect divided into variable cost and fixed cost. Now based on this analysis, this is called strategic analysis of profitability. And please understand, at one point of time, the profitability analysis used to be done only at the top level, that is operating income, or at the bottom level, that is net profit, without going into details, just by calculating the variances. But this kind of analysis, the analytical tool which we are using, that is growth component, price recovery component, and productivity component, this is a new contemporary technique in strategic cost management. This kind of analysis is a new contemporary technique in strategic cost management. So that is why it has its great importance, special importance. We do have the variance analysis as a backup calculation. But nowadays top management will always do this profitability analysis by breaking it into three components. Again and again, I'm emphasizing on these three words so that they get registered in your mind. Number one, growth component. Number two, we have price recovery component. And number three, productivity component. Growth component and price recovery component divided into two parts, revenue effect and cost effect. Cost effect further divided into two parts, variable cost and fixed cost. And we have productivity component divided only into one part, and that is cost effect. right? By putting all these effects of different components into the reconciliation statement, our reconciliation statement should tally. So let us look at the reconciliation statement, how it looks. Reconciliation of operating profit. It is in front of you. Reconciliation statement of operating profit. You have operating profit of last year, right? That is given in general, and you have cost and revenue, because you are dividing these effects into cost effect and revenue effect as far as growth and price recovery is concerned. For productivity, there is nothing like revenue effect. So accordingly, the table has been designed. As you can see, I'll annotate this so that you will be able to highlight growth component. Next one is price recovery component. Growth component, price recovery component, and third one is productivity component. These are the keywords which we use. And we do add or less. All of you can see this, add or less, depending upon favorable, adverse, positive, negative, and so on. So if we have growth component, and growth component is favorable in terms of cost, we add. In terms of revenue, any favorable thing we add, adverse we deduct, right? Simple way to remember. And if it is cost, then we show it in cost column. If it is revenue effect, then we show in revenue effect column. So you have growth component further divided into two parts, cost effect and revenue effect, right? All of you are clear on this. Price recovery component again divided into two parts, cost effect and revenue effect. Cost effect and revenue effect. And productivity, which is again only into one part, and that is cost effect. Productivity is not in terms of revenue. So we are not taking productivity in terms of revenue effect. It is only cost effect. Finally, you should arrive at net effect of cost and net effect of revenue, and the net effect, revenue minus cost, and get the operating profit in the current year. So we start with operating profit of last year and work out operating profit of the current year. So this is called profit reconciliation statement. So my dear friends, you will always be given profitability data, the financial data for 2 years. In a case study, generally which appears in the exam, you have cost data, you have profitability data for 2 years along with other financials, and you have to bring together different figures, play with numbers. In strategic cost management, I always say we have to play with numbers, we have to play with figures, bring together two numbers in such a way that they make sense, they make meaningful analysis, and carry out a meaningful analysis of profitability for 2 years. Making use of these three techniques, these three words, three components, growth component, price recovery component, and productivity component. Alright, so we will look at the illustration that will make this concept 100% clear in your mind. Once we look at the illustration, you will have 100% clarity in your mind. This is the problem from the module, illustration given from the module which is in front of you. Try to understand each of these columns properly. Y Limited is a manufacturer of cardboard boxes. An analysis of its operating income between 2017 and 2018 shows the following. So you are given income statement of 2000, I will have to highlight this. You are given income statement in 2017. And you are also given income statement in 2018, the first and the last column. These are profit figures, income figures, revenue cost figures for 2 years. So for example, you can read the 46,20,000. Now what is responsible? It is 2 lakh rupees is favorable on account of revenue and growth components. I am highlighting these words, growth component, and you are given price recovery components. Price recovery components. And you are given productivity component. So what is the effect of cost and revenue? In terms of growth and price recovery, there is revenue and cost. Here also there is revenue and cost. But in terms of productivity, only cost. You can make out, only cost. Right? And all the calculations are in front of you. You don't have to separately calculate these figures. They are given, favorable or adverse. Now, Y Limited sold 4 lakh boxes and 4,00,000 boxes in 2017 and 2018. During 2018, the market for cardboard boxes grew by 3% in terms of number of units. See, there is a increase in the market size, that is 3%. When it says in the market, highlight the word market. Market has increased by 3% in terms of growth in volume. And all other changes are due to company's differentiation strategy, that is product differentiation strategy and productivity. So it could be cost leadership, it could be product differentiation, it could be efficiency in operation, that is productivity, any of these strategies. But 3% is the market growth. That means it is market size. All of you understand? It is market growth, that is market size. And balanced growth is on account of your own initiatives, management initiatives in terms of cost leadership, in terms of product differentiation, innovation, etc., etc. Right? So this is a peculiar scenario and you have to work out. Now read the question. All of you have understood the data now. Let us look at the requirement of the question. The question says required compute how much of the change in operating income. We are on the chapter strategic analysis of operating income. Strategic analysis of operating income. So obviously you are asked to analyze the change in operating income from 2017 to 2018 due to one, industry market size. Industry market size here is 3% market size. Then productivity. And third is product differentiation. See, order can go here and there, no problem. But basic three words remain the same. One is market size, that is what is the growth. Second one is productivity. And third one is product differentiation, that is nothing but the price recovery effect. So also reconcile the profit of both due to these factors. So there are two requirements in this question. Find out the change in operating income from 2017 to 2018 due to these three factors. That is part 1 of the question, and part 2 of the question, profit reconciliation you have to do. So let us look at the approach now. Being the first problem, we will understand the approach from the solution which is given immediately below this. See, right now we will not understand the figures, only look at the structure. Only look at the structure, the format. What is the main question? Prepare a reconciliation of operating income. So this will be the standard format in which you will prepare reconciliation. Any statement you will give title. So most important thing is giving title. Reconciliation of operating income. This is the title what is given. Without title, if you prepare any statement at final CA level, certainly that will give a wrong impression. That will give a wrong signal. So please give title to every statement. Reconciliation of operating income. We write particulars and amount. First column we have operating income in 2017 and we arrive at operating income in 2018. This will be the standard format you will prepare every time when you are asked profit reconciliation statement to be prepared for 2 years. So operating income in 2017 is 10,80,000 and operating income in 2018 is 14,42,000. We can compare this with the data given, and between these 2 years figures, there are three factors responsible for change in profit. Which are the three factors? So we say change due to, we don't know increase or decrease. So we say change. It could be increase, it could be decrease. Decrease hoga to we will deduct. If it is increase, we will add. So change due to industry market size. Market size is nothing but 3% growth in the market. This is the growth effect. That change due to productivity. That is efficiency in operations. Working note 2. And change due to product differentiation. Product differentiation is cost leadership. You have price recovery, etc. You can see everywhere there is a working note. Working note 1, working note 2, and working note 3. See how methodical approach. This is how in costing, but this is basically a costing paper, strategic cost management. You should be methodical. You should be very, very structured in your presentation. Let the examiner get the feel, evaluator get the feel that yes, this student is very professional. Right at a student stage, he or she is very, very professional. Look at the way the student is preparing the statement in a professional manner. Right? This is how you are going to prepare the statements, MIS statements for the analysis or for the decision making of top management. What are we learning? We are learning this performance measurement system for the purpose of analysis of top management. So same statement you are going to project, you are going to present to the top management tomorrow once you start working in the corporate. So it has a practical relevance as well, and therefore develop this discipline within yourselves, wherein whenever you prepare a statement, you will give a title to the statement, proper columns, particulars, amount, then effect is reconciliation is asked. So there will be profit of the last year, profit of the current year, and in between 2 years profit you will give the factors responsible for, and factors responsible in terms of this chapter number 10. So you have to use the same words. I cannot be generic in my communication. Please understand. I cannot be generic in my communication. I cannot say because of increase in volume, increase in price, increase in cost, decrease in, like that I can't say. I have to use these 3 words categorically as part of chapter number 10. Please understand, this is a part of academics, and therefore as part of academics, when you present something, it has to be in the appropriate format. So you will say increase, decrease nahi bolenge, we will say change. Change can be upward, change can be downward. So change due to market size, that is called growth factor, change due to productivity, that is efficiency in operation, and change due to product differentiation. Product differentiation, cost leadership, all because of price recovery effect. Right? And we will give referencing, cross-referencing, working note 1, 2, 3, etc. Now let us look at the working. I spent so much of time so that you could understand the format, the template of the statement, how you should prepare. Just working is not enough at CA final level. In the professional manner, you should be able to present your findings, present your workings. Right? With this common or generic instructions, let us move ahead with workings. So I'm not going into any of these numbers right now because we will have to prepare the workings. So first we look at the market size factor. Market size factor is nothing but the growth factor. So we have the first working note, and it is given a general working given that total increase in the sale of cardboard boxes is 20,000 boxes. From 4 lakh boxes, the number of boxes increased to 4,20,000. 20,000 boxes से सेल बढ़ गया. So out of this 20,000, 3% is assigned to, attributed to. Again and again I am using the word assigned to, attributed to. 3% of 20,000, 3% of 4 lakh is assigned to growth factor. Total market size is 4 lakh, for example. Right? 4 lakh से 4 lakh 20,000 हो गया. That means 3% increase, 12,000 का increase is on account of market size. Market size is growth factor. Can we say therefore growth in market size is 12,000 and growth in market share is 8,000. Now you understand the difference between market size and market share. This 8,000 is market share, whereas 12,000 is market size. 12,000 is market size and 8,000 is market share. Can we say market size is on account of industry growth? Is on account of industry growth. Nothing to do with management initiatives. But market share increases because of management initiatives, management strategies which are adopted to increase the market share. So we are responsible for increasing the market share. Management is responsible for increasing the market share, not for market size. Market size is beyond control of management. This is as per growth in the industry, growth in the product segment, that particular product which belongs to a particular category or a product segment basket. Overall, there has been an increase, and so my company's sale also has increased. So I think all of you understand breakup of 20,000 into 2 parts. 12,000 increase is on account of market size, whereas 8,000 is on account of market share. See, calculations are not at all difficult, and therefore you will understand them very fast. It is how you put up professionally. Now, growth factor, we are dividing effect of industry market size on operating income. Growth component, we are dividing into combined revenue and cost effect. Together, revenue and cost effect. So look at this. Total revenue and cost effect is given to you 1,40,000. Now we bifurcate this, or we divide this on a pro rata basis, proportionate basis, in terms of increase in sale unit due to market growth and divided by total growth in sales. Total growth in sales is 20,000 boxes, and 20,000 boxes के लिए revenue and cost effect is given together. Why are we not bifurcating between revenue effect and cost effect in this problem? Because the breakup is not given. You are not given the breakup of revenue and cost. The combined effect is given, and that is 1,40,000. ये कहाँ से आई figure 1,40,000? Go back to the question and you will understand. 1,40,000 is given. revenue effect and cost effect. Look at this operating income. The data says the revenue and cost effect. I'm highlighting this figure. This is the figure I'm lifting. 1,40,000. This is the figure I'm lifting. See, out of so many figures, you should understand which figure you are lifting. Why I'm lifting 1,40,000? Because I'm preparing profit reconciliation. So obviously operating income I will pick up. And operating income I will pick up as revenue and cost effect given together. Revenue effect and cost effect given together. Revenue effect is 2 lakh favorable and cost effect 60,000 adverse. So we pick up net effect, that is 1,40,000. Right now in the reconciliation, for reconciliation purpose, we don't divide into revenue effect and cost effect. Though the data is available over here, it will be unnecessary time consuming, and therefore we will have a net effect of 1,40,000. So 1,40,000 is the revenue and cost effect of growth component. This is prorated. This is divided proportionately between the factors responsible because of industry growth and because of other factors. So here the growth is really big, 3%, that is industry growth. So 1,40,000 multiplied by 12,000. The 3% of 4 lakh is 12,000. 12,000 units or 12,000 boxes has increased because of increase in the market size. So 1,40,000 multiplied by 12,000 divided by 20,000. Look at these calculations which are given. Any doubt you have in any calculation or any of the figures, you can ask. Again, you cannot by heart the formulae, you cannot memorize the formulae, not required. You are expected to apply these formulae. So revenue and cost effect of growth component. This is how you will write categorically. Revenue and cost effect of growth component in 2018. That is 1,40,000. And 1,40,000 multiplied by 12,000 boxes, which is increase in the market size, divided by total increase, that is 20,000. Look at this calculation and try to do these calculations on the calculator. See whether you are able to make sense by doing these calculations. Do this calculation, 1,40,000 into 12,000 upon 20,000, and you get the answer 84,000 favorable. That means 84,000 is the effect of growth. So this is working note 1. We can say that because of growth in the market size factor, the operating income has gone up by 84,000 rupees. So that's it. We will apply this 84,000 in the reconciliation as it is. So again, going back to we'll keep on moving our cursor up and down, scrolling up and down. See, 84,000 is this figure. All of you can make sense. 84,000. That's why I'm annotating every figure every time. 84,000 is working note 1. Any questions you can ask. And the title is change due to industry market size factor, or you can say growth factor. Growth factor, working note 1, 84,000. Now productivity factor is always 1. There is nothing like revenue effect. Productivity aspect is only on account of cost effect, and that is readily given to you as 58,000. So this 58,000 is picked up. You can see from the question which is given. 58,000 is given in the question itself. 58,000 is given in the question itself. Here it is. Cost effect of productivity component. All of you can see this. Cost effect of productivity component. Again, I will annotate to highlight the figures. Cost effect of productivity component. We are looking at productivity component and at the operating income level, because we are doing profit reconciliation. So 58,000. And this is exclusively on account of cost. You can make out. This is the cost exclusively on account of cost. 58,000. Nothing on account of revenue. So this is directly given, readily given. There is no question of bifurcation, pro rata allocation, etc. So straight away 58,000 favorable, we will add in the reconciliation. So this is the cost effect of productivity component. So let me just take you back to the reconciliation statement. Reconciliation statement, 58,000 and working note 2 we have given. 58,000, here it is. Working note 2. Every figure you need to understand properly. So 58,000, 84,000 we understood, now 58,000. Now what is the breakup of this? There is no breakup, it is directly given and we have lifted, but still there is an explanation given in working note 2. So let us read working note 2. Working note 2 says very clearly that there is a productivity effect. And productivity effect is because of cost. It is given cost effect of productivity component in 2018, 58,000 favorable. That's it. So directly given, there is no separate calculation. It's only cost effect. I wanted to say only cost effect, no revenue effect. And the third one is most important, and that is effect of product differentiation on operating income. Now product differentiation, I told you, is nothing but on account of cost leadership. It could be on account of price recovery. So we have price recovery component, and here there are three factors responsible for product differentiation. One is growth in the market share. Growth in the market share. If you remember, growth in the market size, we had apportioned 1,40,000 on the basis of 12,000 boxes. Now remaining 8,000 boxes is on account of market share. So let us first understand this third calculation first, which it's fresh in your mind. This is the calculation I am talking about. Growth in market share due to product differentiation. Product differentiation is producing a different specification of the product, different dimension of the product, different quality of the product, which will add value to the customer. Product differentiation, whereby some added features, added benefits, advantages offered to the customer. Besides designing a new product design, new product make every time so that it catches the attention of even the new customers. So growth in market share due to product differentiation. 1,40,000 we have apportioned on the basis of market share increase, and that is 8,000. So 1,40,000 into 8,000 upon 20,000. If you recollect, in the growth component, we had taken 1,40,000 into 12,000 upon 20. So जो balance 8,000 है वो इधर लिया, जो 12,000 था वो market size था, balance 8,000 इधर लिया, market share, and you get the answer 56,000 favorable. So this is what is growth in market share due to product differentiation, right? And now let us look at the price recovery effect. Price recovery component. Price recovery component divided into two parts. Selling price effect, that is the revenue effect, and the cost effect. Price recovery factor divided into two components, revenue effect and cost effect. So revenue effect is given to you, cost effect is also given to you, and that we will pick up from the question, from the data which is given. 1 minute. So we will look at the data. The highlights are given here. There is a star which is produced here. So let us look at the star also. It is the formula which is given. Revenue and cost effect of growth component in 2018 multiplied by increase in sale unit due to product differentiation. Product differentiation upon total growth in sales units. So same thing, what is done in the form of numbers in the bracket is given in the form of formula. That's all. And these two figures, price recovery component in terms of increase in selling price and increase in the price of inputs, basically price recovery. So we have revenue effect and cost effect. That is given 4,20,000 favorable and 256 adverse. You can see in the original problem, I will highlight 4,20,000 favorable and 2,56 adverse. You can see this. 4,20,000 favorable and 2,56,000 adverse. So revenue effect and cost effect, again of price recovery component. Time and again I am highlighting on the keywords growth component, price recovery component and productivity component. So price recovery component, again you have revenue effect and cost effect. Both we show separately, right? Now separately because we are anyway having the product differentiation effect also as part of this, and therefore we take 420 and 256. Now you can see this embedded in the calculation. So in our working note 3, we have taken into account this 420 and 256. Look at this. 420 and 256. 420 and 256. Increase in the selling price, that is revenue effect, and that is 4,20,000 favorable. And there is cost effect, revenue effect के बाद cost effect. Cost effect is input prices, cost in terms of input prices. Revenue effect is output price, selling price increase, and this is cost effect of price recovery component, that is 2,56,000 adverse. Now if you take a combined result of this, so I will annotate, if you take a combined result of this, that is 420 favorable, 256 adverse plus 56 favorable, the net effect comes to 2,20,000 favorable. Do this on the calculator. Keep the calculator, 12-digit calculator in front of you when you are doing the working. Anytime you sit for the strategic cost management, numerical paper, you must sit with the calculator. Do this calculation, it comes to 2,20,000. Right? Now we go back to the original reconciliation statement. We go back to the original reconciliation statement and see whether the reconciliation tallies. Yes. There is a change. Working note 3, just now we highlighted working note 3, which says 2,20,000 is on account of product differentiation, and working note 3 expressed the breakup of 2,20,000. Product differentiation, though it is mentioned here, you can say price recovery. Price recovery could be on account of revenue effect, on account of cost effect, and also product differentiation, cost leadership, etc., etc. All that is 2,20,000. So if we take a combined effect again of all three things, just add, all are favorable, and therefore easily you can add these figures. 84,000 plus 58,000 plus 2,20,000. All three figures if you add and add to 10,80,000, you get the answer 14,42,000. Just add करके देखो, 10,80,000 plus 84 plus 58 plus 2,20,000, you get 14,42,000. That is operating income in 2018. So 2017 का operating income था 10,80,000, 2018 का है 14,42. So 10,80 and 14,42. Let us compare with our original data, original question. Yeah, we had picked up from the original question, but once again to be doubly sure, 10,80 and 14,42. 10,80 and 14,42. See, here are the figures we had lifted from the original question. See, from the given data, you should know which figures you should concentrate on for analysis purpose. 10,80 is the operating income of last year, and 14,42,000 is operating income of the current year. So first thing is plot PLOT. Plot these figures in the reconciliation statement, so that you are ready with these two ends, E and DS, two ends. And now you have to fit these factors, components into the reconciliation statement. And these three words are also given in the question, so you don't have to struggle. Remember, three words are growth component, price recovery component, and productivity component. Revenue effect, cost effect, except the last one. So we are through with this analysis of profitability using a new technique of profitability analysis, that is three models: growth component, price recovery component, and productivity component. Based on this analytical comments, you can always give that profit has increased because of these factors, etc. So we are through with section 1, first section of this chapter, and that is profitability analysis using three components, namely growth component, price recovery component, and productivity or efficiency in operations. Now we go to the second component, and that is through activity-based costing, making use of ABC, how we can analyze the profit. So we have product profitability analysis, direct product profitability analysis, DPP model, and second is customer profitability analysis, CPA model. Right? We will understand this, but before that, let us highlight, let us jot down, right, in our separate whiteboard, Word document whiteboard, separately the learnings out of this, so that it is registered and you also have your notes which are ready. Just now we have completed, go to the module contents. Now let us make our own notes based on the understanding. So the chapter, the whiteboard is open in front of you in the form of Word document. Where there is a clarity in understanding. The name of the chapter is Strategic Analysis of Operating Income. And we are doing profitability analysis using various techniques. So here we say three components are used. You can highlight this. Three components. Impact of three components. I will say three components effect. Effect or impact of three components. Effect of three components on operating income or on profit. On profit. You must get some time to digest, to register in your mind. That is why I am highlighting this. Yeah, we have understood the concept. We have understood one case study or an illustration based on this concept. So now some time to digest, some time to register what we have learned. And that is why this whiteboard, that is why these highlights. So effect of three components on profit. Number one, we have growth component. Growth component. I will not write component again because it will be repetition. Growth component divided further into parts. That is revenue effect and cost effect. Revenue effect and cost effect. Then second one, price discovery. Price discovery. Again we have revenue effect. Like that you make your notes so that they will be handy reference material for studying for the exam. Revenue effect, and then we have cost effect. Cost effect further divided into VC and FC, that we understand if further data is given, VC and in case data is available. In case it is not available, then fine, VC and FC. And the third effect is productivity effect. What we understand, efficiency in operations. Productivity effect or productivity component, it is called efficiency in operations. Efficiency in operations. Efficiency in operations. And this is based on only one, and that is cost effect. So here we don't take into account revenue, because in productivity there is nothing like revenue. It is only cost effect, because it is purely based on volume, that's all. So when we talk about cost effect, it is purely based on volume. Volume of output. Volume of output for the given input. I am not elaborating further, but volume of output for the given input, or ideal input that is required for output, input and output, for mix variance, yield variance, same understanding we have and same approach we adopt. So this is the learning so far what we have done. Profitability analysis, this is section 1. I am highlighting section 1, profitability analysis. Or profitability analysis section 1. Because the roadmap should be very clear in your mind. Now we have section 2, and that is this different color I will give, that it catches the attention. Section 1, profitability analysis. And now section 2, we go to activity-based costing, and there are two sub-techniques over here. Section 2. And that is ABC. I am writing in short, activity-based costing and profitability analysis using activity-based costing. We will write this, we'll continue writing this slightly later after we understand from the module. So all of you are able to see this. I will now go back to the module. We have profitability analysis through activity-based costing. Now, just try to understand first what do I tell you about ABC. ABC you have already studied at intermediate level and on some or the other occasion in strategic cost management also. In this chapter, we don't have numerical problems on activity-based costing. Don't get confused. Chapter number 10 talks only about product profitability analysis. It talks about analysis of operating income, right, using various techniques. That's all. So it doesn't talk about activity-based costing in detail. So numerical problems on activity-based costing are covered somewhere else in the same paper in strategic cost management, but in the initial part, right? So right now we will not solve, in today's class, we will not solve any question on activity-based costing, numerical problems on activity-based costing, because that is not within the scope of this chapter. Right? Please understand and please bifurcate. If the topic is very much there, but that is in your other, it's the same subject, but in some other chapter. So activity-based costing, but since the reference is made, we need to understand. At one point of time, companies used to adopt absorption-based costing. Please listen to each and every word which I speak and register in your mind, in your ears. that at one point of time, companies management used to adopt a traditional or conventional method of costing, and that was called absorption costing. Absorption costing was based on some predetermined basis. Predetermined basis could be machine hours, they could be labor hours, and if you recollect the cost sheet which you used to prepare in intermediate or even during final, you always say that production overheads are absorbed as a percentage of some or the other cost, say prime cost. Or we say admin overheads are absorbed as a percentage of, say, cost of production. Is absorb the overheads as a percentage of, as a part of some or the other cost based on past convention, past experience, past practice, based on the management policy. And there can be ad hoc way of, ad hoc, arbitrary way, I use the word ad hoc, arbitrary way of allocating the cost to the product. So what used to happen was, in traditional absorption based costing, the product cost is not determined with accuracy. You cannot find out the real cost of the product with 100% accuracy. There may be a case that there is over-absorption of overheads or under-absorption of overheads. This also you studied. I'm just giving you a background and refreshing the concept of absorption-based costing which you learn at intermediate level. There can be over/under absorption of overheads in absorption-based costing because we never consider actual overheads. We always absorb the overheads as a percentage of some or the other cost using a predetermined basis. And that predetermined basis could be number of machine hours, number of labor hours, volume of output, etc., etc. Now there can be a lot of ad hocism. It may be allocated or apportioned on ad hoc basis, arbitrary basis, based on management policy or based on past, which may not hold good in reality. And therefore, to that extent, the absorption-based costing happens to be a traditional method of costing, a conventional method of costing. Current management, that contemporary management philosophy is to track every element of cost, to track every element of cost of the product via activity. I use the word via activity. That means via factors responsible for that activity. In short, if is being used for a particular product, for manufacturing that product, then we assign the cost of that activity to the cost of the product. I repeat, if any resource, there are a number of resources which are used while manufacturing a product. This activity-based costing is peculiarly, traditionally in manufacturing industries, but of late it has been also extended to service industry. So now ABC is followed in both manufacturing industry as well as in service industry. In manufacturing industry, when we talk about manufacturing or production, the question arises, does this product pass through all the phases? Does this product pass through all the steps, all the departments, all the phases, all the steps, all the departments? Does it consume all the activities? If the answer is no, then why do we allocate cost of all the activities to that product? The question is being asked, point to ponder. I call it point to ponder. This question is asked by the management to itself, that why should we allocate cost of an activity or a resource which is not used for manufacturing that product? Why should we assign cost of that resource or an activity to the product? We will not. We will assign the cost of the resource to the product cost only if that resource is used by the product. Right? That's why I said, please listen to my each and every word very, very carefully and register it in your mind. I will assign the cost of the resource or cost of an activity to the product if and only if that resource or that activity is consumed by, utilized by that product. If the product doesn't make use of that resource, if the product doesn't make use of that activity, why should I assign the cost of that activity to the product? That is the management philosophy when they adopt activity-based costing. And therefore, they have to then divide the entire product manufacturing process into different activities. So therefore, activity is the base, or it is the bottom line, on the basis of which costs are all assigned in a common pool called cost pool. I'm just refreshing these terms because they are fresh in your mind. You have studied during intermediate and even during your final also, you have studied this. Cost pool is a common place where a cost of different activities are compiled together, are drawn together and kept in one basket, kept in one pool. That is what is called cost pool. And from that cost pool, you assign individual elements of cost to different products, but via activity. You assign to the product via VIA, via activity, right? That is the route. That is the roadmap, right? Traditional costing, we assign the cost directly to the product, or to products we divide on the basis of suitable basis, apportionment of overheads, right? But in activity-based costing, certain activities we don't use at all for manufacturing certain products, then cost of that activity is not assigned to the cost of the product. Simple example given in your module is various facilities. Let us understand in service industry, various facilities that are provided by a hotel. For example, a hotel industry is providing facilities like, for example, a garden, etc., which is or an empty space where people can a joggers park or a walking track where senior citizens or even elderly people can walk and they can have a morning walk. So for them, the joggers park or that track, walking track is laid down and a garden is built up. There is a bar, BAR bar, for those business guests who stay in the hotel who would like to have their business meet over a glass of wine. And therefore, there is a bar facility which is provided. And of course, you have other amenities like, for example, a gym or other recreation amenities which youngsters may use in the hotel. So hotel is catering to all types of customers, and therefore all the more when we look at profitability analysis of each customer, or when we look at product analysis, a product profitability analysis, obviously management will look into the cost of each of these activities. Now, frankly speaking, so much minute brainstorming, minute water compartments of cost and minute bifurcation is not done. And we also discussed that activity-based costing lacks from one important limitation, and that is it is a Herculean task. It is very, very difficult task, laborious task, time consuming. It requires complete revamping of the processes, complete revamping of your business model, business processes. Value chain has to be defined. Value chain analysis has to be carried out. Non-value adding activities have to be done away with. Value adding activities have to be concentrated on. Now, this is a very great process. It's a time consuming and laborious process. And the management philosophy should be in favor of activity-based costing. So this is a practical difficulty also which is encountered by many companies. They don't want to change their past practice of following absorption-based model of costing, so they may not go for ABC. But those companies which have gone for ABC in their product costing have realized that product cost shows or presents a realistic figure of cost, a realistic picture of cost. Shows real cost, then obviously pricing strategy also is based on the cost. Product profitability is also maintained. So this is the background or base I have created for you. That is activity-based costing. We have cost drivers, another concept. Cost drivers are factors which affect the cost, or factors on the basis of which the cost is determined, cost is allocated. For example, floor space or the storage space in terms of square meter, square feet, etc. for allocation of warehousing cost, etc. So, or electric points in terms of, or kWh in terms of electricity cost, power cost to be apportioned to different products. Right? So we do use different bases of apportionment, different factors which affect the cost. These factors are called activity drivers, factors which affect the activity and thereby the cost of the activity. Right? And therefore, all the more I said activity-based costing is important, but this entire framework has to be in place. And this framework, when management designs as a part of its philosophy, that is called activity-based management. Management philosophy is to, yes, have activity-based budget, compare the actuals with this activity-based budget and look at the deviation, look at the variation and pluck out all the loopholes in our system. And continuous improvement is when you design activity-based management framework in the organization, continuous improvement in the product quality, in the profitability, in the volume of output, etc. All these are at the back of your mind. I have spoken a lot about activity-based costing. This is just to give you a brief that how there is a paradigm shift in our profitability analysis, right? So let us first look at direct product profitability, that is DPP. We are on DPP. I will annotate this, DPP, direct product profitability. Now read the first line itself. For a profit-making organization, profit earned from an operation is a KPI, key performance indicator, which assures and controls direction towards organized objective. Right? Today what happens is we are concerned with the different types of markets, different types of consumers, and therefore when we are dealing with such a wide product range in a competitive environment, at one point of time if there was no so much of competition, then fine, you can have your own business model, it can be static. But now when you are operating in a competitive environment, Michael Porter himself said that you have to adapt yourself according to the business environment in which you operate. And therefore, you have to design your product portfolio, your product mix, your market share, etc. based on the market conditions, based on the market environment. And product which gives maximum profitability should be highlighted, should be focused on. So you should have a product portfolio, product basket, which brings the highest profitability. And DPP, direct product profitability, therefore, is used to measure the profitability of an individual product. Look at this. It is used to measure the individual profitability of the product. Each product's profitability is measured with the help of DPP. It assists the management to know the true profitability to take appropriate decisions. Right? It is exactly opposed to traditional absorption costing. That is what I was telling you all this time. It is exactly opposite of traditional absorption costing, where normally labor hours or machine hours are used as a basis for absorption of indirect cost or overheads. Direct cost anyway we can assign, we can attribute directly to that respective product. But when it comes to overheads, overheads are apportioned on the basis of a predetermined basis in absorption costing. And that predetermined basis is subject to bias. It is subject to management policy. And therefore, all the more, it is not a foolproof method of product costing. Absorption costing is not a foolproof method of product costing. It doesn't give reliable results of cost and thereby the profit. That is what is discussed here. DPP uses variety of measures like space used for transportation, storing of goods, refrigeration time, etc. Some goods may require special storage in terms of refrigerated van, in terms of cold storage facility. Some products may require a general storage. So accordingly, the product costing when we are doing it, you cannot apply the same electricity cost or the storage cost to all the products using the same basis. It has to be different according to the need of different facilities or activities. So DPP has a base of activity-based costing. DPP generally used in retail trade. That is what I was telling you. Direct product profitability as a technique is used generally in retail trade to determine profitability of the individual product. So it is generally used in retail trade. That is direct product profitability. We will understand the benefits of direct product profitability. SIMA has given, the Certified Institute of Management Accountant has given the definition of direct product profitability. It is attribution of purchase price and other indirect costs. For example, distribution, warehousing, storage, retailing, supply chain, and logistics. All these retail costs, indirect costs are also apportioned to different products, right, using different basis. And thus net profit as opposed to a gross profit can be identified for each product. So far what used to happen was, we used to, in traditional costing, that is absorption based costing, we cannot find out net profit of each product. We can find out operating income of each product. Operating income is at the top level. That is at the business profitability level or gross profit level. Because I know the cost of goods produced or cost of production, and therefore I simply deduct from my sales cost of production, and what I get is the gross profit or operating cost of goods sold, and what I get is operating profit or operating income. But now, if I want to know what is the net profit of each product, that can be ascertained, that can be determined with 100% accuracy if you are logical in your apportionment of indirect costs, particularly distribution, warehousing or retail costs to the different products. These are common costs, but depending on their quality, keeping in mind activity-based costing, if you can assign respective element of cost to different products, accordingly, your product costing will be more reliable, right? For example, here one example is given, warehousing space and transport time. These are the measures or key performance indicators, KPIs, or measures of allocation. Right? You can apportion warehousing space, how much square meter area is used for storage. What is the transport time? How much time you are taking? It is 5 hours, 8 hours to the respective destination. So depending on that, the product will get its share of cost of transportation. And that will reflect the resource consumption of individual products. That's what I was talking about, resource consumption. Resource consumption. Is that resource being used by a particular product? If yes, then cost of that resource must be assigned to that product. If resource is not used by the product, cost of that resource should not be assigned to the product. As simple as this. Benefits of direct product profitability measure. Benefits are like this: better cost analysis. We all appreciate and understand. Better pricing decisions. If my cost data is more authentic, more reliable, then I can have my pricing decisions which are based on this correct cost. Better management of stores and warehouse space, because I know how much space is required for each type or category of the product. So utilization of resources properly and rationalization of product ranges, right? Rationalization means product mix here. Right, product mix, management will be in a better position to have a basket of different products, because each product we can find out separate profitability. Products which are contributing or giving highest profitability, they can be always projected, or they can be placed at a place in the retail store, particularly at a prominent place. You all understand the storage of these or the display of these products. All of you have gone to the mall, and therefore you understand, or to a departmental store. In a departmental store, typically the products which are carrying high margin, or which are newly introduced products, or products where there is an adequate margin, very high margin for the dealer, for that shopkeeper, obviously he will display that product on the shelf at a very prominent place. And products like, for example, which example should I give? The tissue paper, for example, box of tissue paper, where the margin is very limited, very minimal, maybe hardly any margin or no margin at all in tissue paper box. In such products which are low price products, or which are bulky in terms of their volume, bulky in terms of the storage space, but such products may not get so much of attention, and therefore they can be sidelined. They can be kept at the back. They need not be kept near to the billing counter. They need not be kept near to the billing counter. They need not be at the prominent space, prominent location in the retail store or in that particular departmental store. So this is called positioning of the product positioning or arrangement of the product on the shelf. That much luxury, that much cushion always the stores manager has to keep the product, display the product according to its prominent importance, So rationalization of the product range. That's a separate topic. These are all qualitative factors we are discussing, of course, but it has its relevance in financial terms as well. So these are benefits of direct product profitability. Direct product profitability, we have advantages: better cost analysis, better pricing decision, better management of stores and warehouse space, and rationalization of product ranges. Right? These are some of the advantages of direct product profitability. How do you prepare a direct profitability statement, direct product profitability statement? Retail organizations traditionally deducted bought-in cost of goods from the selling price. Bought-in cost of goods from the selling price. पहले क्या होता था? सेलिंग प्राइस से वी यूज टू डिडक्ट ओनली कॉस्ट ऑफ गुड्स परचेस्ड. ए टिपिकल ट्रेडर, दिस इज द कॉस्ट ऑफ परचेस एंड दिस इज द सेलिंग प्राइस. सो सेलिंग प्राइस माइनस बॉट इन कॉस्ट ऑफ गुड्स will give you a gross margin. At the retail organizations, a gross margin. That's it. But now gross margin is useless, very categorically given. It is useless. Why? In decision making. It is a useless measure for controlling the cost. A useless measure for controlling the cost of the organization or making decisions about the profitability of different products. If I want to measure product profitability, I cannot measure product profitability at the net profit level using this traditional approach. So making decisions about the profitability of different products, making decision about the controlling of cost, areas of cost control, you cannot take such decisions using gross margin. So gross margin is measured, right? It is, yes, at the back of mind, but net profit is more important as far as product profitability is concerned. So far it was not possible, but now this method, direct product profitability method, enables the management to work out net profit of the product, each product separately. Now why it was not possible? This is because none of the costs generated by the retail organizations are included in this calculation. This is the point. Why this gross profit margin is irrelevant for decision making? Because the costs which are incurred by retail organizations, costs which are generated and incurred by retail organization like warehousing, transportation, supply chain, logistics, time, and again I am giving this example. These costs are not captured in our product profitability were not captured in the earlier traditional profitability statement of the product. For example, it doesn't include the storage cost of different goods, and these costs vary considerably from one good to the other. That means from one product to the other. Storage costs are not included in the gross margin. Gross margin will deduct only the buy-in cost, the procurement cost of that particular product, the bought-in cost of goods. We don't deduct the transportation, warehousing cost, etc., storage cost, etc. And therefore, there is a need for the method which will enable management to work out product profitability at the bottom line, at the root cause level, and that is what is net profit and net profit of each product. This method is called Direct Product Profitability Method, DPP, and we prepare a DPP statement like this. So statement is given in the format. Various indirect costs, basically it is allocation, apportionment of indirect costs for DPP. They are analyzed into categories like this. Some examples are given. Now this is based on common sense understanding. Overhead cost, for example, first one, overhead cost. This is incurred through an activity that is not directly linked to a particular product. So it is based on activity. Bifurcation is done. Right? Volume related cost. Cost is incurred in relation to the space occupied by the product. Typically the storage and transportation cost. Storage cost mainly, space occupied by the product. Volume related basis, bifurcation of overhead. Product batch cost. Product batch is number of units produced in each batch. So this is based generally on a time-based cost. In a month you are producing how many batches? 5 batches. 4 batches of the product. That means how many number of units, identical units which you produce in one batch. So they all are stocked on shelves. So labor time cost is incurred, product batch cost. And fourth is inventory finance cost. Inventory finance cost is the money which is blocked in stock, and cost of product multiplied by the interest rate per day per week. It is something like an opportunity cost, inventory financing cost. So basically indirect costs for DPP purpose are analyzed into cost categories like this. Overhead cost, where we follow activity-based costing, volume-related cost based on space, etc., product batch cost based on time, and inventory financing cost based on the interest rate or the opportunity cost. A typical product profitability statement, direct product profitability statement, looks like this. First time some of you might be looking at this statement for the first time, direct product profitability, because so far we are used to conventional method of profitability statement where it is sales minus cost of bought in goods. So it is sales minus cost of goods sold, cost of bought in goods. That will give me gross margin. That's it. And then what we used to do, net profit we used to work out for the company as a whole, for the organization as a whole. Now here we are tracking the profitability of each product, right? Or rather each specification of the product. That is also possible. Why on the product? Each specification of the product. So direct product costs are deducted, wherein we capture warehousing cost, transportation cost, storage cost, etc., etc. And we get direct product profit. This direct product profit, DPP, is very reliable, very authentic. You have precise determination of correct profit. That is one of the advantages we discussed of DPP method. So table 1 shows, for example, the numerical figures along with this format is shown to you, but now the figures, with figures it is explained further. Direct product profitability statement looks like this. Selling price is 150 minus bought in price is 80. So gross margin is 70. Traditional method. less direct product cost, we deduct warehouse cost, transport cost and storage cost. So direct product profitability, you can check the calculation 16 plus 18 plus 22, right? All these three direct product cost, you minus from gross margin 70 and you get direct product profit, that is 14 rupees is the direct profit. Now here there is some additional information that is given. It is a warehousing and storage cost will include labor, space and insurance cost. When we talk about warehouse and storage cost, you have to appoint a godown keeper, you have to do maintenance, upkeep of the godown, a warehouse, you have to take insurance policy on that warehouse, you have to incur cost on account of premium, insurance premium, then the rent, if godown is taken on rent, then you have to pay rent. So many costs you have to incur on maintaining a storage space. So all these costs now will get tracked down at the product level, right, when you do direct product profitability analysis. Same way transportation cost will have labor component, right, transportation cost in terms of driver's salary, attendant salary, so labor cost, then fuel cost, which is a major component, vehicle maintenance cost. So number of trips can be the basis for this transportation cost. For warehouse cost, it could be the storage space or volume of goods. Yeah, so these are the basis. Even the risk is also, there are some exceptions also. Insurance cost may be better spread on value or on a risk index. See, insurance cost we do not bifurcate on the basis of volume, not correct. Either you take the value, always insurance is bifurcated on the basis of value, or it could be on the risk index. Why? Because certain goods require special care to be taken. They have to be stored in cold storage or they have to be transported in a refrigerated van. Goods which are required to be stored under lock and key in cold storage in the godown, they have to be transported from the warehouse to the dealer's location to the dealer's place in a refrigerated van. The cost of refrigerated van is higher than general transportation and therefore you cannot assign the same total transportation cost to both the products. You have to do this bifurcation of products, right, into different categories according to the requirement of an activity. That is the point I am driving. If certain activity is required for a certain product, do assign the cost of that activity to that product. Refrigerator van required for transporting, say, aluminum foil. Aluminum foil is a costly material. It has to be kept under lock and key. And that aluminum foil cannot be stored in a general transportation mode. It has to be taken in a refrigerated van, or any perishable products have to be taken in refrigerated van, like milk, for example. So these products, when you are transporting, you have to assign the cost on the basis of the cost of refrigerated van. So that is what is the activity. So perishable goods or costly products which require special transportation facility, there is a greater risk involved. So risk also is an underlying factor. So we look at the direct product profitability cost analysis, and it gives you a quick understanding that if a retail store, a typical retail store or a departmental store is storing all these products, ice cream, baby food, toothpaste, wine, paper tissues, all these products are stored in a departmental store. The gross margin may be very high, but direct product profitability is very low. Now this is, you may think, is it an irony? No, it is not an irony. This is the fact. All these years it was not visible to you, right? Because we were not adopting the direct product profitability analysis, it was not apparent to us. It was not obvious to us. Obviously, that particular dealer is under impression that ice cream is giving him a gross profit margin of 20.40%. But if you look at the direct product profitability analysis, ice cream is giving a DPP of only 4.60%. Now look at this drastic difference between the gross margin and DPP. Right? Drastic difference. It's a great difference. Gross margin for ice cream is 20%, but direct product profitability is only 4.60%. Can you think of one single reason? One single reason is the cold storage facility. Ice cream has to be stored in cold storage. It has to be transported in a refrigerated van. So the cost of transportation, cost of warehouse storage is very, very high. So all these years, these costs were not getting captured in our product profitability analysis because we were not doing product profitability analysis at the bottom level. We were doing only at the operating margin level. And operating margin is showing a very fantastic picture, 20.40%, but that is a misnomer. Please understand, these are the wordings you have to use in the case study analysis. You have to, time and again I have been emphasizing, every case study carries numerical analysis and also qualitative analysis. Numerical analysis, you all are experts, you can do the calculations fast. But when it comes to qualitative analysis, you have to emphasize on certain keywords, right? And you have to express your views in polished business English, So you say gross margin is a misnomer. Misnomer. You can take down this MISNORMER. Misnomer means misleading. Gross margin is misnomer. It gives a misleading picture of product profitability. The real profitability of the product is reflected by DPP, direct product profitability. So, ice cream, we have seen one example. I gave you example of paper tissues. That is another. Paper tissues is a height 15.70% margin, gross margin. This dealer is enjoying, but DPP is only 0%. There is no DPP at all. In fact, it is a break even. You can say cost is equal to revenue. Right? There is no margin at all in this tissue paper. See, what happens is tissue papers occupy a lot of space in terms of bulky volume, but margin is very minimal. And therefore, product profitability shows a 0%, but gross margin shows 15.70%. Now, a particular departmental store or a particular say retail outlet cannot keep this paper tissue out of its store. It will have to keep some stock, because you as a departmental store or as a retail store, you have to keep stock of all the goods. You are catering to masses. Now these are qualitative factors. You are catering to masses, and therefore you have to keep all kinds of goods. Customer may stop coming to your shop if certain goods he doesn't find in your shop, in the retail outlet, and therefore whether you like it or not, you have to keep these products. But then the product positioning comes into picture. These products can be displayed, can be kept in a sidelined manner, in a sidelined position where it may not catch the attention. But products which have high margin or newly introduced products, highly profitable products, can always be displayed at a prominent place so it catches the attention of the consumers. Products which are highly in demand can always be kept on the rack. This is how the positioning, your module discusses about product positioning, particularly on the racks, and this is a decision, this is merchandising decision. Right? Any merchandising decision relating to displaying the stock and in what position on the shelves certainly can be taken, but you cannot do away with that product. That is the point. Right? These are qualitative factors which must be kept in mind while doing qualitative analysis of a given case study. We had looked at the quantitative approach in detail. We'll take a case study on this DPP, direct product profitability analysis, after the break. So we take a short break of 10 minutes, and after this break we will continue with the second section of our product profitability, or rather the profitability analysis, and that is using ABC, activity-based costing, which consists of two parts. Don't forget, one is DPP, direct product profitability, and second one is customer profitability analysis, CPA. Right? Both of them form part of section 2, which is doing profitability analysis. This is used activity. So we will tackle this particular case study on direct product profitability after the break. Thank you. Jay, can we start? Jay, can we start? So we look at the case study on the direct product profitability. You are given a situation. A company has 30 retail stores of uniform sizes. Name of the store is Fruity and Sweetie Retails. Some names are given, catchy names, so that you can certainly remember the problem while studying. Fruity and Sweetie Retails across the country. Mainly 3 products, namely butter jelly, fruits and nuts, second product, and icy cool are sold through these retail stores. Basically, in this retail, there are 3 types of products which are sold. Company maintains stock for all the retail stores in a centralized warehouse. All 3 item stocks are kept in a central warehouse. Goods are released from the warehouse to the retail stores as per requisition raised by the stores. So retail stores will raise the requisition, and based on that, goods will be released from the warehouse. Goods are transported to the stores through 2 types of vans, normal and refrigerated. These vans are to be hired by the company. So company has to incur cost on account of transportation also. We have to basically apportion or allocate these costs of transportation, warehousing, etc. to 3 products, butter jelly, fruits and nuts, and icy cool, using different basis. So let us look at the cost per month data. Cost data is given to you for the company. Warehouse cost is given in terms of labor and staff cost 27,000, refrigeration cost 1,52,000, and material handling cost 28,000. So total comes to 2,07,000. Head office cost, which are apportioned to the different products later on, but head office costs are allocated on some other basis using the management policy or decision. Salary and wages to head office 50,000, office cost is 1,27,000. So your HO cost are 1,77,000. In direct product profitability analysis, we don't allocate head office cost. Keep that in mind. In direct product profitability analysis, we don't allocate head office cost. We allocate direct product cost in terms of retail cost, warehousing cost, retail stores cost, transportation, and so on. So retail stores cost are again labor related cost. Then you have refrigeration cost and other cost. 3 items are given. Refrigeration cost, as you can understand, based on the refrigeration facility used or that activity used, you will apportion to different products. If certain products are not required to be stored in refrigerated van or not required to be stored in cold storage, then you don't assign the cost. And average transportation cost of company per trip to any retail store, per trip it costs 3,200 in normal van, and in refrigerated van it costs 4,900. This data given to you. The chief financial manager asked his finance manager to calculate profitability based on 3 products sold through Fruity and Sweetie retail stores rather than traditional method of calculating profitability. So the question itself gives you a hint of the chapter number 10, from where we are learning this case study, that we are comparing traditional absorption based costing versus contemporary or strategic tool or technique of profitability analysis using this product profitability, direct product profitability. So calculate profitability based on 3 products sold in the stores. This is a simple question that is asked. You are also given some additional data or allocation or apportionment. This is the data which is given. Retail stores are gathered. Number of cartons per cubic meter 42. 28 and 40. We will read this slowly so that it is easy for you to register what is given. Number of cartons per cubic meter. Number of items per carton in units given. 300, 144 and so on. Sales per month in units are given. 18,000 and so on. Time in warehouse, that means butter jelly has to be kept in warehouse for 1 month. Fruit and nuts generally stay in warehouse for 1.5 months. That means that is the stock holding policy, that is the inventory policy. And IC cool is stored for half a month in the warehouse. Then there is a time in retail store also. In retail store, generally butter jelly remains for 1 month. Fruit and nuts probably take more time to get sold in the market. So 2 months रहते हैं retail store में. That means they don't get easily picked up, right? And that is what is the time required to get converted into sales. Inventory, selling price and purchase price is given. This selling price and purchase price is nothing but the direct product cost. You can understand. So traditional costing, what we would have done, deducted from selling price, purchase price. And we said this is the operating margin or the profitability of each product. But then we were not in a position at that time to do the allocation of these common costs, particularly transportation, warehousing, etc., right? Which we are now able to allocate precisely. That is the point. Butter jelly and IC cool are required to be kept under refrigerated conditions. So please understand the peculiar requirement of this product, butter jelly and IC cool. They have to be kept in cold storage. So fruit and nuts can always be kept in general storage, and you can always carry them, transport them in general vans. That is also possible. Some more data is given to you below this, and that is additional information. Total volume of all goods which are sold per month, 40,000 meter cube. This is the total volume of all goods. And total volume of refrigerated goods sold per month is 25,000. So that means when it comes to allocation or apportionment of these overheads for each product, the first and the third product, namely you had the product first and third product, butter jelly and IC cool, we will take into general transport, fruit and nut in refrigerated van. So fruit and nut, we will take it in, we will divide the cost or overheads on the basis of 25,000 meter cube. Whereas other two products, we divide the total cost into per unit or something on the basis of 40,000. Remember this. Carrying volume of each van is 64 meter cube. This may be for transportation purpose. This is each van will carry volume of 64 meter cube. Calculate the profit per unit using DPP method, using direct profitability method. So we have to prepare a profitability statement using direct product profitability. Look at the approach. Direct product profitability statement. Right? We first prepare a main statement and then the working notes. Selling price per unit 84, 42 and 26 picked up from the question. Minus purchase price picked up from the question 76, 34, 22. So gross profit or operating margin is 8, 8 and 4. That's it. This was up to here, it is traditional method of costing. Now direct product cost we also apportion among the products. So warehouse cost, retail stores cost and transportation cost. तीनों कॉस्ट के लिए एक एक वर्किंग नोट बनाएंगे. सो वी विल प्रिपेयर वर्किंग नोट 1 फॉर वेयरहाउस कॉस्ट, वर्किंग नोट 2 फॉर रिटेल स्टोर्स कॉस्ट and working note 3 for transportation cost. Now let us go to the working note to understand these calculations. So warehouse cost. Let us understand warehouse cost, how it is calculated. Working note 1. Warehouse cost, warehouse related cost. First, there are two statements you have to prepare every time in the working note. Working note में always two statements you have to prepare. One is statement showing cost for different types of facilities, different types of activities. Cost per activity, cost per facility, cost per activity. Using ABC, activity-based costing. And second is apportionment of these costs to each product. So product-wise analysis. Right? So you can see first statement is this activity-wise bifurcation and then product-wise. Now here you have product-wise. See? Here you have product-wise. Second statement we have prepared product-wise. So every working note you will prepare two statements. One is activity-wise and then allocating those activity rates for calculating product cost. So product-wise. Now therefore the challenge for the students in such kind of question is to envisage the contents of the table, envisage the contents of this table, rows and columns. What will be in rows and what will be in columns, that nobody will dictate or dominate. You have to understand how should you prepare a working note to enable you to get the desired figure. How should you prepare the working note to enable you to get the desired figure? That is what is the challenge for the students always, and that too in the example. Right. So here I have divided this into two activities. One is general cost, because general activity, general cost driver, and cost is related with refrigerated goods. In this case study, these are the two activities. Therefore, like this. Now, in some other problem or other case study, you may have different activities like spray painting, finishing, assembly, like that. You know, in a typical machine tool operations, you may have fabrication, spinning, you may have dyeing or drying, you have spray painting, etc. So in such cases, then you will have so many columns also. Here you have only two activities. One is general activity and other one is refrigerated activity. So general cost and cost related with refrigerated goods. Labor and staff cost is a general cost. You all can make out. Material handling cost is also a general cost. But refrigeration cost is a specific cost. And that is with respect to refrigerated goods. So usko दूसरे column में डाल दिया. So now my total cost is 55,000 general and 1,52,000 refrigerated goods. I divide this by volume of goods sold. Volume of goods is 40,000 metric cube. Volume of goods sold in general category. General category, first and third product. And second category of the product, that is 25,000 for refrigerated purpose, or it's the other way. First and third product is refrigerated good, and second product is general category. So let's look at the cost implication now of each product. If you have understood, if you do the calculations, 55,000 divided by 40,000, it comes to 1.38. Do it on the calculator. 55,000 upon 40,000, you get 1.38. Similarly, do 1,52,000 divided by 25,000. You get 6.08. This is again per unit, per metric cube, right? Per month, right? Now we multiply this by number of metric cubes of respective products. That is also given to you. So look at this second table where product-wise costing we are doing. Butter jelly, time remains, we are doing warehousing cost, and warehousing cost will be apportioned on the basis of time spent in the warehouse, time for which they are stored in the warehouse. So 1 month butter jelly is in stock, 1.5 months fruit and nut, and IC is for 0.5 months. So we will multiply this by cost per metric cube. Cost per metric cube we arrived at 1.38. That is only for fruit and nut, because that is in general category. Whereas refrigerated van will have not only refrigerated category. This is again a challenging point. 6.08 plus 1.38. Now while I was speaking, some of you might have thought, sir, you are dividing this into two parts, generic category and refrigerated van. But जो refrigerated van में जाता है, उसके लिए generic category costs are also there, like labor cost, staff cost, other admin cost, material handling cost. They are there even for refrigerated van products also. So in ideal situation, we should add this, and that is what we are doing. We are adding 1.38 and 6.08. So don't forget in the exam to add these two figures. If you pick up only 6.08 here, then your answer will go wrong. Calculations will go out of control. So you have to add a point to be noted. Please students note this, 1.38 plus 6.08. This will consume, butter jelly will consume both the activities, general cost as well as refrigerated van. Why? Because there are some common costs like material handling cost, warehouse cost, वो भी तो आएंगे. So 1.38 भी आएगा और 6.08 भी आएगा. But when it comes to only generic category product like fruit and nut, it will take only 1.38. And then IC will be once again total, both refrigerated as well as general. This is the point which is most important according to me for in this problem. You must understand these three figures. Because if rate applied goes wrong, then your total cost will go wrong. And your entire product costing will go out of control. So you will multiply this 7 point. This is very important. Very, very important. 7.46 into 1, you get 7.46. 1.38 into 1.5, you get 2.07. 7.46 into 0.5, you get 3.73. Alright. So this is the working we have done for warehousing cost. And now we get product wise warehousing cost. That is what is direct product profitability. So for butter jelly, the cost is 7.46. For fruit and nut, 2.07. This is the direct product cost in terms of warehousing. So I once again go back to my original table from working note 1. Remember this figure 7.46, 2.07 and 3.73. So we will go back to the main table and see the figures are captured over here. Warehouse cost is captured over here. Warehouse cost is 7.46, 2.07 and 3.73. This is the warehouse cost, and reference given is working note 1. Working note 1. So traditional costing, we ended our calculations at this juncture, at this stage, 8, 8 and 4, finish. But now in the contemporary technique which we use for profitability analysis, that is DPP, direct product profitability analysis, we also take into account direct product costs like warehouse, retail, transportation. Now in the same manner, you have to do allocation or apportionment of retail stores and transportation cost. So let us go to working note 2 and working note 3. See, when you look at this, you understand very well. But you should be able to do these calculations independently in the exam. And that is the challenge by preparing the correct working notes, and that too in suitable formats. So let us look at working note 2, retail store related cost. Warehousing related cost ho gaya, abhi retail store related cost. Retail store related cost, again two activities, general cost and refrigerated goods. So again here you have labor cost, labor related cost 33 and other costs which are in generic nature. Whereas refrigeration cost is specific, 1,09,000. Again you divide this by same manner, what you did for warehousing, same manner you are doing for retail store cost. That is 40,000 metric ton, metric cube and 25,000 metric cube. You divide. So 109 upon 25,000 you get 4.36 and 80,000 upon 40,000 you get 2. So cost per metric cube per month is 2 rupees for general category and refrigerated category 4.36. But friends, as you understand, when you are taking product number 1 and 3, which require refrigerated storage, etc., refrigerated transport, obviously 2 plus 4.36, both figures you have to consider. So 6.36 lena padega. 2 plus 4.36. But when you are looking at second product, fruit and nuts, then you will take on the generic category, that is 2. By this time now you are clear, so I need not repeat. So this is table number 1 in working note 2, which is activity-wise cost and now product-wise cost. So first table is activity-wise cost, second table is product-wise cost. So product-wise cost we prepare like this. Again 3 products, butter, jelly, fruit and nuts and this. And look at this table again, the calculation. So butter jelly is in retail store for 1 month, fruit and nut for 2 months and ICAI for 1 month. This data is picked up from the case study. Cost per metric cube we worked out in the above working, that is 2 plus 4.36, 6.36. This is only 2 because no cold storage required, and this is again 6.36. Multiply 6.36 by 1, 6.36, 2 into 2, 4, simple calculations, 6.36 into 1, 6.36. So now we have the figures 6.36, 4 and 6.36. So go back to the original table and replace them. Replace these figures over there in the cell. So go back 6.36, 4 and 6.36. Here it is, 6.36, 4 and 6.36. You can see this. 6.36, 4 and 6.36. This is the breakup. Retail store cost per metric cube. This is from working note 2. On the same lines now we will go for transportation cost. Look at the transportation cost. Working note 3. You have to have great patience and keep tab on each number. In costing, students, you are aware, you have to keep tab, T-A-B, keep track of each and every number, figure. It's all number game. I repeat, today's topic, what we are doing, it's all number game, calculations. And data is all scattered in the case study. So you should have adequate maturity, patience, balanced, maturity, patience, balance to pick up the right figure, right data for right analysis. And that requires, yes, maturity level. Your concept should be very thorough. So transportation cost, again 2 activities. One is normal van, other one is refrigerated van. So here you have cost per trip 3,200 and 4,900 given to you, right? And divided by, obviously transportation cost will be divided on the basis of now volume of van. Each van can carry 64 metric cube of the product, all products, or 64 metric ton of all the products, refrigerated van. So cost per metric ton comes to 50 rupees. If you divide 3,200 by 64, 50 rupees. And if you divide 4,900 by 64, it is 76.56. So very simple. Again, second table we will prepare. Here cost per metric ton, second table, Number of items are given. You can see this. Where you can calculate number of items. Number of cartons given are 42 and number of items per carton is 300. So you divide 42 into 300. See, all workings are given. All workings are given. Number of cartons are 42, 28 and 40. And each carton contains 300, 144, 72. So obviously इसको multiply करके you get number of items, number of units बोलो, number of items बोलो per metric cube. And just now we had cost per metric cube. So obviously you will now multiply 50 rupees by each of these costs. So I take you further. Here instead of two statements, three statements we will have to prepare. So one statement is for two activities. What we have done, generic and refrigerated van, then number of items, right? And we go back to this. We go back to the original table and look at these calculations. Look at the transportation cost. Transportation cost we worked out was 76.56. That was for generic category. And that was for cold storage facility, and once again 76.56 for cold storage facility, whereas 50 rupees is for generic category. It is generic, that is why transportation cost is less, right? So directly we got the answer from working note 3, right? And that working note 4 was prepared for calculating number of units, because we have to calculate cost per unit, cost per item bolo, cost per unit bolo, whatever. So total direct profitability, product profitability comes to 90.38, 56.07 and 86.565. How did you get this figure? You will take total of all these costs. I will annotate. You will take total of all the costs. Be comfortable with the calculation. Check the calculation. Add all these three figures. 7.46 plus 6.36 plus 76.56. You get 90.38. 90.38. Total DPP cost per metric cube. Right? Total DPP cost per metric cube, 90.38. Warehousing, retail plus transportation. Now, we can't subtract from 8 rupees, 90 rupees because this is per metric cube. Right? And therefore, it has to be converted into cost per item. So how many items are there? This is per metric cube. How many items you manufacture? How many units you rather store or sell per metric cube? That is 12,600. And if we calculated in working note 4 where number of cartons and again the metric cube, number of items in each carton and also in metric cube the data which is given. So cost per item will be 90.38 divided by 12,600. Do this. 90.38, do it on the calculator, divided by 12,600. You get 0.007. See on the calculator you can get this figure 0.007. Yeah, cost per item. You should do like to like operations, like to like. You have the gross profit which is cost per unit. So obviously you have to subtract cost per unit of direct product cost. So 0.007 is deducted. So what you get is 7.993. See, under now the analysis, in the original, the traditional cost, absorption based costing, we used to say that product butter jelly gives a gross profit of 8 rupees. But when you take the profitability to the bottom level and to the root cause, you say the profit is not 8 rupees 100%, it is 7.993. Doesn't matter a marginal difference, but we need to deduct those warehousing, transportation and retail store cost. It is very much essential for determining the correct profitability of the product. This is the message which you get from this case study. Right? Similarly, this 8 minus same manner. Add all these three. That comes to 56.07. 56.07 divided by 4032. These many items are there. So you get 0.04. And that is 7.986 is the real cost of the product. Similarly here 3.97 is the real cost of the product. This is called direct product profitability. Direct product profitability. DPP method. Any doubt you have, you can ask. Okay? So this is a part of our profitability analysis using ABC. So whatever, now we go to the second subpart of this, and that is customer profitability analysis. But before that, whatever we learned in direct product profitability, we will document it on the whiteboard in terms of our Word document. So that will be very easy for you to understand and do the study based on the referencing. So this is sort of a reference file which we have prepared in the form of a whiteboard. So section 2 is profitability analysis using ABC. Profitability analysis using ABC. In this, there are two methods. One is DPP, direct product profitability. I am writing the short forms. And second one is customer profitability analysis, CPA. In direct product profitability, we deduct the retail cost, warehousing cost, transportation cost from the operating margin in order to arrive at the net profit of the product. So product profitability at the net, so operating margin, I'm writing the formula, operating margin or operating profit minus retail oblique warehousing oblique transportation cost. These have to be captured. Direct product profitability means operating margin minus retail, warehousing or transportation cost to arrive at net profit of each product. So that is equal to net profit of each product. That each product is important, not net profit for the company or the organization as a whole. No. Net profit of each product wise profitability is kept. That is the base, right? And this makes use of activity-based costing. I told you, any resource which is used for a particular product, the cost of that resource will be captured, will be allocated, will be apportioned to that product, otherwise not. Now we look at the second technique using ABC, and that is customer profitability analysis. This is again a new paradigm shift in the profitability analysis. In a traditional manner, conservative way, management used to do profitability analysis only in terms of net profit. Now, how much value addition each customer is making to the organization's profitability, that is what is measured. So can we say it is something like a 360-degree appraisal? Here on one hand, we give value addition to the customer, but also management does profitability analysis in terms of what value addition that customer brings to the organization's profitability. Which customer is yielding more contribution, higher contribution than the other customer. So which customer should be given more priority in terms of catering to his needs, in terms of giving special discounts, special offers, etc. We always say loyal customer, a customer who purchases the products on a regular basis from the store, obviously gets a due treatment, a privileged treatment. Now that happens only based on some calculations. Just directly by saying that so much volume of goods he is buying on a monthly basis cannot be the criteria. It has to be quantified in monetary terms. So product profitability analysis, just as we are doing, we also do customer profitability analysis, where we find out the profit per type of customer. Profit per type of customer, per customer. So let us understand, it's a paradigm shift in the approach and therefore contemporary technique in strategic cost management. This is mainly important for service organizations. I told you customer profitability analysis is more important for service industry, particularly banks, financial service customers, financial service companies, hotels, right, which are mainly into providing service to the customer. For example, a bank, customer enters into a bank, how long he has to wait for various types of services. Maybe he has to take a demand draft, he has to do the remittance, he has to do the NEFT. How long? Now, of course, these things have now become redundant or useless because of online banking. So therefore bank may not be the right example, but in the module, still the module is old module, and therefore it still contains the example, because some people are still using the physical banking facility where withdrawal of cash, authorization for overdraft, request for statement, stop payment request, returning the check because of insufficient funds, bouncing, all these things. For everything, customer had to go to the bank and resolve his issues, right? So how fast you cater to customers' needs or requirements, right? Definitely it is an issue. And in a competitive, again I am repeating, in a competitive environment, it matters. The service industry today faces a lot of competition. At one point of time, there was no much of competition, and therefore traditional absorption-based costing method was acceptable. But with change in the business dynamics, change in the environment, external environment, now you have to have such kind of contemporary techniques in strategic cost management. So in a hotel industry, the module talks about the example which I have given you. A hotel may have number of activities. For example, a laid out garden, or a walking track, jagger track, swimming pool and bar. Older guests may appreciate and use the garden. Families may use the swimming pool. Business guests may use the bar. So each type of customer is availing, AVAI, is availing different types of services. The focus of customer profitability analysis is, if a customer avails a particular facility, cost of that facility should be attributed to that customer, right? Otherwise not. Same logic what we understood in direct product profitability. If a customer enjoys a particular facility, particular amenity, that cost of that facility or amenity should be charged to that customer. So we identify the cost of a service via activity, via resource, right? That is again activity-based costing we are using, right, in the service industry for apportionment of cost. So it is given in the module, if activities are charged to relevant guest, a correct cost per bed occupied can be calculated for this type of category. Many hotels do this kind of costing? Question mark. Because I told you practical bottlenecks or difficulty in implementation of this system in real life, and that is, it is a Herculean task. It is a laborious and time consuming process, right? You require to do mapping of your products, mapping of your services with the activities, and complete value chain has to be defined. An organization which doesn't have a value chain which is predefined, it is very difficult to assign the cost of each activity in the value chain, right? So this is a practical difficulty or a bottleneck in implementation of this. But ideally speaking, hotels should be doing like this, so that cost per bed, cost per room is charged on the basis of facilities or amenities which are availed by a particular type of customer. Right? So at least we learn in real life, yeah, by the time you start working in the organization, probably yes, even the service industry also would have geared up to that extent, and they would be ready to take this challenge of activity-based costing. But certainly in banks, you must have heard of Six Sigma. Six Sigma operations carried out were revamping of the processes, streamlining of the processes which is done in banks to provide value-added service to the customer. Right? So customer-centric focus, that is the main prerequisite, objective here when we talk about customer profitability analysis. Some advantages are given. It helps the supplier to identify which customers are eroding overall profitability. My goodness, this is a very harsh word, but that's a fact. Some customers don't add any value. In fact, they erode the value. And we learned in our EVA calculation, at least if we can't contribute to value generation, we can't erode the value. So if some customers are eroding the overall profitability, then probably a different decision the management will have to take. Which customers are contributing to the profitability? So such kind of analysis, customer profitability analysis, and it also provides a basis for constructive dialogue between the buyer and the seller to improve the margins. See, again, we are talking about win-win situation. Some customers may be located at a long distance from the factory and transport cost may be more for them. Right? Other customers may be disruptive and place rush orders that interrupt production scheduling, require immediate special transport. Now, obviously, any urgent purchases or immediate purchases will cost extra because the transportation arrangement has to be made immediately, and all the more when the customer is located at a long distance from the factory. So you have to make quick arrangement of the component at his factory, and therefore transportation cost will be higher. All these business dynamics have to be kept in mind. This is customer profitability analysis. At least we are happy that in the new syllabus, at least the brainstorming is happening where we have a dialogue in the class as well as while studying for the exam about these new contemporary techniques in strategic cost management, namely direct product profitability and customer profitability analysis. Both make use of activity-based costing. Let's look at the illustration or a case study based on customer profitability analysis. Students, these problems are not so easy to tackle in the exam. I am always worried about not the calculations but about the tables, working notes. That students should have clarity in preparing the working notes, preparing the tables, presenting the data in a tabular form. What should be in rows and what should be in column is not defined anywhere. It is your call. And for that, you must envisage what is the expected data for doing the calculation, what is required for the final destination. And data is all scattered. In a case study, particularly, the data is all scattered. So you will have to collate the data, pick up the data, relevant data, put it in the right format in the working notes, which will enable you to reach the destination. That is always the challenge, and particularly at final level. Therefore, do lot of practice, solve these questions. There are a number of questions given in each chapter, not only as illustrative questions, but also test your knowledge questions. Do solve them physically, practically, right? Like under exam conditions. Just reading of these questions, one can understand because you are CA final students, but you should be able to solve this independently in the exam without losing track of any numbers. Let's look at this case study. Last case study on customer profitability analysis. A and B are two customers of XYZ Electronics Limited, a manufacturer of auto players. Selling price per unit is 5,400. Cost of production is 4,420. Additional costs are given. Order processing cost 2,000 per order. Delivery cost is 3,500 per delivery. Details of customer A and B are given to you. Audio players purchased 350 and 500. Please note, see, when you read the case itself, you should read between the lines. I keep on telling this every time. Customer A is purchasing only 350 units from the company. You can say 30% of what customer B is purchasing, 30% less. Yeah, 30% less. Now this aspect should be highlighted in your analytical comments, in your narrative comments. See, customer A is purchasing 30% less than customer B. Can we say customer A is a loyal customer or a high value customer? No, immediate impression what comes to your mind? Not really, because customer A is buying only 350 units, 30% less than customer B. 30% of 500 is 150, 500 minus 150 is 350. This is called loud talking. This is called loud thinking. When you are reading through a case, you should read between the lines like this. Keep these observations at the back of your mind and quote it at the time of giving the narrative comment. Number of orders. This customer is placing 5 orders each of 70 units and customer B is placing 10 orders each of 50 units. All of you have studied in intermediate level EOQ model, economic ordering quantity, where we do a trade-off, a sort of trade-off between the ordering cost and the holding cost. Similarly here, some customers place less number of orders, but each order is of high volume. Some customers may place large number of orders, but each order is of less volume. Each one's liking, pasand apni apni, but there is a cost implication. Please understand. When the customer A is placing 5 orders, order cost will come down. But customer B is placing 10 orders, so order processing cost certainly will be more. Jitne order ज़्यादा, utna order processing cost ज़्यादा. right? So that way company has to suffer in terms of additional cost for customer B. Order processing cost is higher. But delivery cost is also to be taken into account. Customer A is making only 5 orders and therefore delivery cost is per 5 delivery होंगे तो 5 delivery का cost भी कम होगा. इधर 10 delivery हो गए तो cost of delivery also will be higher, right? जो always remember costing करना है तो एक एक cost जोड़ना पड़ेगा. Not a single cost you can leave aside, or you cannot leave aside or leave any cost to be used. You have to make use of each and every cost data. Do a thorough analysis. Number of deliveries are 5 and 0. Look at this. 0 delivery. Why 0 delivery? No. Customer B may be placing an online order. Let's see why 0 delivery. Company's policy is to give a discount of 5% on the selling price on orders for 50 units or more. Alright, 50 units or more, company gives 5% discount. So both customers can avail this 5% discount? Yeah, because one customer is placing 70 units at a time and other one is 50 units. So both are entitled for 5% discount. But there is a special 8% discount on undiscounted selling price if customer uses his own transport to collect the order. ऐसे भी होता है. See, this is the incentive which is given by the company that if customer picks up the goods self service, pick up on your own. That means company's person is not required to deliver. You pick up on your own. If that is the case, then company will give you 8% discount on undiscounted selling price. That means original selling price. 8% discount मिलेगा. Assume production levels are not altered by these orders. Yeah? I think complete data is given. Very interesting case study. Analyze the profitability by comparing the profit per unit of each customer. You have to calculate profit per unit of each customer and comment on the discount policy on delivery. Is it in order or not? Is discount in order? On delivery particularly, because it's wondering why 0 orders for why 0 deliveries for customer B, because really customer B is picking up the goods on his own and therefore there is no delivery required, no delivery cost. On the top of that 8% discount is given, right? So all these thought, see, I never rush to the solution. I read between the lines, think, talk loudly. Talk to you loudly means exam hall, you have to talk to yourself, yeah? But it all thought process which goes on in your mind, and in costing it is very essential. Fine. We come to the approach now. Traditional profitability statement. First we'll say customers profitability, where we start with selling price 5,400 each. Selling price remains the same. Number of units sold are 350 and 500. Less discount, quantity discount, it's all shown in front of you, it's all there. Quantity discount, that is 5,400 into 5%. This is discount on quantity, bulk purchases. And 5,400 के ऊपर वापस 5% 270, because both are buying minimum 50 units at a time, both customers. Discount on delivery is given only to customer B because he is picking up the goods from the retail shop. So on that too on undiscounted selling price. So 5,400 के ऊपर 8% discount. That is 432 given to customer B. So selling price net of discount is 5130 and 4698. Selling price net of discount, right? See, the presentation also matters. Important. This is a MI statement. You are presenting the statement to the top management for decision making. You are a management advisor, management consultant. So presentation of the statement also matters. So selling price net of discount. Each and every figure has to be shown prominently on the face of the statement. Selling price net of discount per unit. Less variable cost. It is 4420, 4420 given in the question. We have lifted. So what you get is contribution analysis. Selling price minus variable cost, contribution. See, generally we do direct variable cost reduction, but here we have also taken into account discount, quantity discount and delivery discount. Now multiply by number of units. You get total discount, total contribution 710 into 350. 710 is the contribution per unit into 350. 2,48,500 and 278 rupees is the contribution into 500. So 1,39,000 is the total contribution. Now there are additional overheads. which are there, delivery cost, and now these are the overheads for the company. That is something has to be captured in calculating the profit. Contribution में नहीं आए थे, but अभी additional overheads have to be deducted. Delivery cost. 5 deliveries take place for customer A and each delivery 3,500. So therefore delivery cost is 17,500 for customer A. Customer B के लिए company will not incur any delivery cost because customer B picks up these goods from the retail store. And order processing cost, 5 order तो 10,000, 2,000 के हिसाब से, 10 orders तो 20,000 at rate of rupees 2,000. So all this data we have captured. And so profit per customer, कुछ भी चीज छोड़ना नहीं, एक एक चीज जोड़ना है. Remember my word. Element of cost has to be compiled properly. Any element of cost you miss out, decision will be tilted. Decision will be tilted. It will go in favor of something else, right? That should not happen. So profit per customer comes to 2,21,000 and 1,19,000. Now look at this. And you divide this by number of units. So because profitability analysis has to be per customer per unit, per customer per unit. So customer A is buying how many units? 350, no? So divided by 350, 2,21,000 divided by 350. करो calculator पे 631.43 आएगा देखो. 2,21,000 divided by 350. It comes to 631. And 1,19,000 divided by 500. Because customer B is buying 500. 238. आपने देखा वो there is something like seesaw, tilted. मैं जो एक अभी word use किया, tilted. Decision is tilted. The picture what is in front of you is altogether different. It is a total surprise. Customer A seems to be more profitable. Customer A seems to be more valuable than customer B because he brings profitability of 631 rupees vis-a-vis customer B who brings only 238 rupees. अभी देखा जाए तो customer A is buying only 350 units, 30% lesser than customer B, but still he is contributing almost double the profit. Now this is called analysis. ये analysis, ये words आपके answer में आने चाहिए. That on one hand customer A purchases 30% less than customer B, but still he contributes profit which is more than double, around double, almost double than profit of customer B. Right? Because overall discount offered to customer A is quite less. So what is eating away the profitability of the company is the higher discount cost. See, this is the culprit. We are able to find out the culprit. Culprit means the factor responsible for lower profit. What is the factor? Which is the element which is eating away our cost? And that is discount. Discount is offered to customer B, which is eating away major cost, and that is why which is contributing to the cost and eating away our profit, and that is why customer B is shown to be contributing less than customer A. This analysis has to be brought out categorically in your answer. And this is first part of the question. Analyze the results. Sometimes students get tired by doing these calculations and they forget second part of the question. Please don't do like this. Second part of the question also comment on discount policy offered by the retail store. Now discount offer on delivery offered to customer B is 432 per unit. 432 बहुत ज्यादा है. आप 238 में 432 ऐड करो जरा. 238 plus 432 है. That comes to around 670. Had this discount not been there, had this discount on delivery not been there, probably the profitability of customer B would have been much higher than that of A. So now it is convinced, we are convinced that customer B is offered this discount on delivery, which is eating away our profit. Right, so discount on delivery offered to customer B is 432 per unit. If you recollect in my original, in my initial classes, initial sessions, I had mentioned to you that always in analytical comments, you should include those figures, you should include those numbers which are not apparent, which are not obvious on the face of the case study. That is called value addition in your answer. figures which are already given in the case study, if you leave them, if you leave those figures and reproduce as it is in the main answer, then that may not catch attention. What is your contribution? What is your value addition as a student? So as a final student, you must always do some extra calculations which are relevant, which are related, of course, in a given case, and produce this in the analytical comments. That will definitely attract the attention of the valuer. And that will show value addition in your answer as well. A qualitative comment, इसको बोलते हैं qualitative comment. So that is what is done. If transport for delivery is provided to customer B, then cost would have been rupees 70 per unit. 10 deliveries into 3,500 upon 500. ये extra calculation किया ना? Question में पूछा नहीं था, but this is something out of the way. This is called going out of the way and doing something extra. Right? That certainly gets credit points in terms of weightage. So cost would have been, had he not done like this, cost would have been 70 rupees per unit, right? Which is lesser by 362. That 362 again is calculated by on your own, right? So if you look at the cost figures again, look at this. 278 is the contribution and usme 432 is the delivery cost. So discount on quantity, right, is 270, 432 is the discount on delivery. So you can say that it may also be noted that delivery cost in case of customer A is only 50 rupees per unit. Hence company needs to review the discount policy on delivery, but significance of profitability of customer B should also be kept in mind while doing so. Significance of profitability of customer B also should be kept. See, this is called typically sitting on the fence, right? I always say case study discussions are always open-ended discussions. A case study is always open-ended, right? And sometimes consultant better to sit on the fence rather than, giving our judgment in favor of or against a particular course of action. Now, therefore, look at the language of the final comment. Company needs to review the discount policy. ऐसे कहाँ भी लिखा नहीं है that discount policy should be discontinued. Now, we do not understand the other qualitative factors. We are outsiders to this business. We don't have complete understanding of the business. And therefore, who are we to comment like this, right? Please discontinue the discounting policy. It's a very harsh recommendation. Don't do like this. You say company may. Use always in the case study analysis the word may, M-A-Y. Company may review the discount policy on delivery, right? May review. It may reduce. We are not saying discontinue. 8% से आप 5% भी ला सकते हो, right? That is also out. Let management take the call. They know the business in and out. You and me don't know the business, and we do not know the vested interest of the interested parties also in these policy measures. And therefore, these are real life undercurrents in the organization, which we do not understand as outsiders, as management advisors, right? So we should just draw a word of caution to the management that please do not ignore profitability of customer B. Customer B is certainly bringing profit of 238. We can't ignore that. Not only that, he is placing bulk orders of 500 units. Dissatisfying any customer is not the objective of any organization, and therefore we want to retain customer B. But to some extent, the discount policy on delivery can be reviewed and revised if felt necessary. Like that, we can leave our judgment in an open-ended manner at the end while ending our discussion on the case study. Now, towards the end, each student may have his own take. So we never say that this is the final answer and the correct answer. Always open-ended case studies like this, you have different views and different takes. So long as you logically explain your stand, explain your take with quantitative analysis, that is important. Nobody will read your qualitative comments if your quantitative analysis goes wrong. So therefore, first and foremost thing in any case study analysis is your quantitative analysis, the calculations have to be absolutely correct. Then only one will pay attention to your qualitative comments. Alright friends, so with this we have finished our second sub part of this profitability analysis using activity-based costing, and that is customer profitability analysis. So product profitability analysis, customer profitability analysis are contemporary techniques in strategic cost management when we talk about profitability analysis. And they are different from absorption-based traditional costing system which used to be followed by the conservative or by the traditional management styles. Right? And activity-based costing, as I said in detail, is there somewhere in some other chapter of the syllabus. It is part of this paper only, but it is part of some other chapter. So numerical problems on activity-based costing are covered somewhere else in this paper, but not in this chapter. So we did not solve any case study or caselet on activity-based costing. That will be covered again when we deal with that topic on ABC. But at this stage, you all understand activity-based costing as a concept. Costs are allocated to the product, apportioned to the product, amongst the products on the basis of usage of resource or activity. That's it. And this is a philosophy at the management level, the mindset of the management. There has to be a proper framework or guideline for implementation of ABC, that is called activity-based management. And all the figures of cost and revenue have to be budgeted. So there has to be a standard set, budget set, actual can be compared against budget, and the variance analysis can be done, right? So that is activity-based budgeting. So ABC, ABB and ABM are all related. Activity-based costing, activity-based budgeting and activity-based management. Alright, I will take some of the questions which are asked by the students. With this we come to the end of the chapter on chapter number 10 on profitability analysis, strategic profitability analysis of operating income, strategic analysis of operating income or profitability analysis. It's a small chapter. One should be prepared for all the chapters, all the topics. You never know which topic may be combined with some other topic and question may be asked. So let us be thorough in our preparation at final stage when we go for the exam. Right? If you refer to immediately past attempt November 19 question paper, this topic was not covered in November 19 question paper. Chapter number 10, directly any of these analysis points were not covered directly. But of course, we keep our fingers crossed and therefore we are prepared as students thoroughly on each and every topic. Yeah? But small topic and therefore only one session weightage in our studies. But you give equal importance to all the topics. I'll quickly take the questions which were asked by the students during the break and now which are updated. The first question, I'm very happy that students are asking for all thought-provoking questions, very intelligent questions. Sir, why price of last year is taken instead of current year in revenue or cost effect? I told you initially, if you refer to my whiteboard in terms of discussion on profitability analysis using these three models, growth, three components, growth, price, discovery and productivity. Do you recollect I mentioned to you while calculating impact of growth on profitability, at that time we take into account last year's figures of price. But when we look at price discovery and productivity, we take current year's figures. Why so? Because growth is always vis-a-vis last year. Growth is vis-a-vis last year. Increase in volume, increase in output of current year vis-a-vis last year. And therefore, inside the bracket, you take current year's volume minus last year's volume, that is output, multiplied by obviously price लेना inside the bracket output, तो outside the bracket price लेना पड़ेगा. तो कौन सा price of last year, that will be taken into account for growth purpose, because growth is to be, मैंने बोला भी था, with respect to WRT, last year, base year is last year and therefore last year. But good, I am happy that you are asking such questions. Second question is, both are related to previous year for VC. Can you please explain? Both are related to previous year for VC. Yes, revenue, I told you, same question in different form. Cost effect for growth is always based on the difference in variable cost, right? That is again for 2 years, and with respect to VC, we'll go to that module once again. We will go to the relevant page of the module. Have patience. so that you can refer to this. It will be easy for you to correlate with the question. Yeah, look at this. For variable cost, that is what you are saying. For variable cost, inside the bracket, standard input required for actual output. Always, I told you also the example of variance analysis where we do inside the bracket it is variable cost effect, and therefore inside the bracket it is standard quantity required for actual output minus actual quantity consumed. Inside the bracket it is quantity consumed, and therefore inside the bracket it is quantity, and therefore outside the bracket it has to be variable cost, input price per unit, and that per component, per unit of that component, and that is once again of last year. So when you take into account cost effect in terms of revenue effect, right? Cost effect and revenue effect in terms of growth component, it is last year only. देखो revenue effect में भी last year है selling price, cost effect में भी last year है, correct, because we are taking into account growth, and growth is with respect to last year. Okay. Sir, what is same question is being asked again and again about the relevance of, I have answered this. What is the relevance of multiplying by current year and last year? This is only for growth, you multiply by last year's figures outside the bracket, but for other two components, namely price recovery and also productivity, you multiply by current year's columns each term. And we also take in third part as growth in market share due to product differentiation as 1,40,000, which is 56,000. Same 1,40,000 minus 84,000. Yeah, in that case study which we handled, yes, even that can also be done. But what happens is, yeah, I'll show you that case study. One student has asked this question. Very interesting. 146 is saying 140 minus 84. That is given in the question. So can we pick up as it is? Changes due to product differentiation is done in working note 3. So breakup of 2,20,000 he is writing. There is the third part which is 56,000. 1,40,000 minus 84,000. Yeah, that also can be done. Because 1,40,000 is the total 1,40,000 is the total cost, out of which 8,000 pertains to market share and 12,000 pertains to market size. So 12,000 का हम लोगों ने already allocate किया. So 140 minus that figure 84 also gives 56. Perfectly correct. Yeah? Clear, no? Yeah, okay. So I think all questions all questions are handled for the day. There was one question for in yesterday's case study where division A makes maximum profit at 6,000 units and division B makes profit. Can we do one more step to fix the optimum transfer price? I didn't understand which step, one more step to fix the optimum transfer price. You can think of any other step also. Yeah, please clarify and please elaborate on this line. Yeah. Alright, so thank you friends for your patience and active involvement in solving these questions. Today 3 case studies we could handle on 3 different topics. One on profitability analysis using different components, namely price recovery component, growth component and productivity component. Second case study we handled was on direct product profitability analysis, and third case study was customer profitability analysis. Wish you all the best for your exams, and any doubts or questions still you can ask. I'll be eager to take your questions in the link that has been provided to you. Okay, thank you. Other no questions further. So we close our session over here. Wish you all the best.